that one really good report we saw yesterday.
You said the bond market is usually in control. It's not actually the Fed. It's the way that bond traders sort of determine rates. That said, I remember the era of don't fight the Fed. That was sort of the mantra that everybody said, and once the Fed would come out, boom, all of the people who were trying to be contrarians would just get blown out of the water. Are we in a new regime where basically the Fed doesn't want to fight markets, not the markets not wanting to fight the Fed?
You know, I don't know about that. I think we do want to look at it from both sides. The Fed knows that they're looking at slightly different things. I mean, when we look at the outlook for inflation and how restrictive policy is, we tend to look at financial conditions from a financial lens. And if you look at it through that lens, financial conditions are still very, very easy. You see credit spreads low, you see stocks continuing to make all-time highs. Things look really good there. The Fed looks at it a little bit differently. So they're not paying as much attention, I think, to what corporate bond yields are doing, treasury yields are doing, equities are doing. They're looking at what's that level of restriction and how's that trickling through to maybe all the people that don't hold as many assets and maybe aren't benefiting so much from that wealth effect.
Jeff Rosenberg yesterday came on of BlackRock after the decision and said, this is a great decision for risk assets. Basically, you're looking at something that supports all valuations going forward because on the margins, this still is a Fed that could cut rates in September and is very cognizant of the labor market. Would you agree? Was this sort of a boost of confidence that the reaction function was validating bets in riskier assets?
I would say it is. You know, we're still not super positive on all risk assets, especially with the bond market, but we're okay with taking risk. We're not suggesting anyone get out of the riskier parts of the market. Investors can still consider junk bonds, bank loans, preferred securities, you name it. It's really valuations that prevent us from being more optimistic. But I think it is a good thing, the fact that the Fed isn't really projecting rate hikes still. I think that's important. If we were to see the Fed being concerned that inflation is not just sticky, but maybe increasing, resulting in more Fed rate hikes, that would be a negative. We didn't see that. And if we look at, again, the comprehensive look at those economic projections, it's still a strong economy. So we're okay taking some risk. One of our preferred ways to take risk is high quality investment grade credit. We think it's a good balance of risk and reward there. Bob Michel mentioned that in those comments earlier, and we're sticking with that outlook.
Colin, there are some people happy in cash. They're getting 5%, and they've been told repeatedly on programs like this that they won't get it for much longer. Then they keep getting 5%, and the Fed keeps pushing back rate cuts. Have you managed to convince those people to deploy that capital?
Baby steps, John. And I wonder how long I'll be on this program before you have to keep asking me that question. Our outlook has not changed, but we look at it again from more of a long-term view. Cash is very attractive. We can't deny that. We always say gradually extend duration because we know a lot of individual investors just haven't really done that. They're sitting in cash because of those high yields, and we'd rather not really be at the mercy of the Fed and lock in some yields with certainty. But one thing that we are highlighting is it's not just the treasury market that you need to look at. I know that's a huge concern for investors. Why the heck would I invest in a 10-year treasury at 4.3% when I can get 100 basis points more with a money market fund and a treasury bill? But if you look beyond treasuries, but still with high quality investments like investment grade corporates that I mentioned before, you can get just as high or even higher yields than what's available in treasury bills or money market funds and still kind of locking it in with certainty. So we're sticking with our call, but we're highlighting that you can look beyond treasuries.
Got it. You let me know if it changes. Colin, it's good to see you. Colin Martin there at Charles Schwab. Coming up next, Mona Mahajan of Edward Jones, Terry Haynes of Pangea Policy, Stephen Cook of the Council on Foreign Relations, and we'll catch up with Mike Collins of PGIM. The second hour of Bloomberg Surveillance up next.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
We clearly are back on a path of progress.
Jay Powell is now holding all the chips. Look at inflation. It continues to come down. That glide path is intact.
At the end of the day, this is an economy that for the moment is still hanging in there.
It does matter when you start the cutting cycle. It really does matter.
I think absolutely September is in play.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It's Thursday. Just to remind everyone, if you're just tuning in, just still can't believe. From New York City this morning, good morning on this Thursday morning. Equity futures are positive on the S&P by 0.1%, 3 consecutive days of all-time highs on the S&P 500. We add a little bit more weight to that. The Nasdaq 100 at an all-time high as well. Plenty of commentary following yesterday. This from Mike Gapon of Bank of America. Don't put the cart before the horse. I'm sure you get it. Chairman Powell saying we need to see more good data.
And that seems to be the theme right now, is sort of the Fed's in wait-and-see mode. The market's in, we'll take that as dovish. On the margins, not as maybe dovish as they had hoped for, but the bottom line is this. If the data is in control, people are taking the signal from the lowest inflation read, CPI read, going back to April of 2021, and that is giving people some real confidence.
It leaves the door open for a September rate cut, potentially. Even Team December acknowledging that in some of the commentary I read yesterday. Some of these forecasts, though, catch you right. Here's one. Unemployment, year-end, 4%. Where is it now? 4%. Year-end next year, 4.2%. 2026, 4.1%. Introduce the commentary of Neil Dutta over at Renmac. The Fed thinks unemployment is going to be flat for the rest of the year. Good luck with that. How much luck do you think they need?
Well, he said, let's get on with it. There are a couple people who think that this is an economy that's tipping, and you're starting to see the labor market just turn on the margins, which is a reason why in about 90 minutes time, it will be interesting to watch the jobless claims. They still are relevant to understand whether we really are on that threshold of a turning point where we actually start to see weakening. We just haven't seen it yet. And this is a Federal Reserve conditioned by their failures, conditioned by what happened in the first quarter of this year, which is much harder than expected inflation. And they don't don't want to be on the wrong side of history, and you could feel that in some of the commentary.
Conditioned by the Fed is not just of Q1, but of the 1970s as well. That's the market of the Federal Reserve. Plenty more on that. We need to track the politics down in the south of Italy. So the president landed in Brindisi yesterday evening, traveled a little north to Fasano, to a beautiful resort. If you ever want to go, I'm not going to name it because they can do their own marketing, but a beautiful resort just on the Adriatic coast. And this is what we understand so far, based on the reporting from Anne-Marie and the team, that the G7 have agreed on how to tap those frozen Russian assets.
Without undermining the precedent of basically having some sort of safe haven in terms of where you park your assets. Essentially, it's a $50 billion loan that is backed by forward interest payments on the Russian assets. Got that? And basically, this is a way of saying we're not actually using your money, but we are using the interest that you might earn off that money for a forward projection. It supposedly is about $2 or $3 billion a year that it earns in interest. All this does to me is to your point, and I think you did this brilliantly, which is essentially say these are politicians that are insecure and want to lock in future financing for Ukraine at a time where there's a lot of dissent at home.
Their future's fragile. I think Anne-Marie used the phrase to election-proof some of these ideas. Just go through the list of people we're talking about. Trudeau in the polls in Canada. Tough time, right? Rishi Sunak. Is Rishi Sunak going to be the Prime Minister a month from now? Based on the polls, highly unlikely. The President of the United States, and that's the key one, Joe Biden, going into November, all through the swing states polls that we've looked at, he's behind. He could turn that around, we'll see, but ultimately he's behind. And we don't know what comes next and what kind of policies come next over the next couple of years. Macron has got his own mess at home. Some people might say that's caused by himself, but he can't run again in 2027. So you go a few years out, that G7 picture looks very, very different. A lot of those people in that picture may not be there.
And there's a great degree of uncertainty of what a Georgia Maloney sort of run G7 looks like going forward if there's a different composition on the ground. What does that mean for Chinese competition? What does that mean for immigration? What does that mean for backing for some of the international efforts, including rebuilding of Ukraine? I wonder what else they're going to try to election-proof, or is this sort of the big jewel that they can kind of crown, given that they've been working on it for many months?
We'll catch up with AMH in about 25 minutes' time. Don't miss that conversation. Equity futures on the S&P 500. Your scores look like this. Positive by 0.1%. In the bond market, yields unchanged. Your 10-year, 431. The euro just a little bit softer. Some dollar strength creeping back in. 107.93 on euro dollar. Coming up this hour, we'll catch up with Mona Mahajan of Edward Jones with stocks at all-time highs. Terry Haynes of Pangea Policy as Trump meets with GOP lawmakers in Washington. And PGIM's Mike Collins on the line between 1 and 2 Fed rate cuts. That line is very fine. We begin with our top story. Stocks at all-time highs as cooling inflation data overshadows a hawkish Fed tilt. Mona Mahajan of Edward Jones writing this. We expect inflation to continue to trend lower in the months ahead, aided by easing labor market conditions and moderating economic activity, which could pave the way for 1 or 2 rate cuts later this year. Mona joins us now for more. Mona, wonderful to catch up with you. What do you think was more instructive yesterday? The data at 8:30, the Fed decision at 2 p.m., or the news conference that kicked off at 2:30?
You know, I'd put it in the order of the inflation reading probably first. I did think the updated set of economic projections that came out of the Fed was probably second. And of course, always interesting to get that tone from Jerome Powell himself. I'd say first and foremost, we do think that inflation print has probably now reset the clock. We are finally seeing this trend of disinflation return into the marketplace, and hopefully we see that in the months ahead. What was interesting to us about the updated set of projections, one, the Fed actually left that kind of 2026 Fed funds rate at 3.1%. So even if there was a shift in the pace to get there, it seems like their direction of travel is still towards a rate cutting cycle. And two, they kind of outlined a soft landing in the economy as well. We certainly saw GDP growth remaining around 2%, the unemployment rate around 4%, all the while inflation moderating. So an interesting set of projections, positive for markets overall.
Positive for small caps as well. The Russell had a bit of a day, had quite a day. It was up by 1.6%, the best day since the start of May. Was it anything more than having a day? Is there anything more to it than just that, Mona?
Yeah, it's a good point. You know, look, I think as we get closer to a potential Fed rate cutting cycle, this theme of this broadening of market leadership, we think gets more and more real as well. And so, of course, part of that broadening is the mid-cap part of the market and the small-cap part of the market. And from a sector perspective, we see not only the tech and growth sectors participating, we could start to see cyclical and defensive parts of the market play some catch-up as well. So I think part of that theme played out yesterday. as the Fed signaled rate cuts, we did start to see a bit of broadening, and certainly small caps played some catch up. I think part of that story is also if we get an environment where inflation does cool, the economy looks like could rebound as we get better inflation prints and lower interest rates. In that kind of upswing in an economy, we do see cyclical parts of the market lead to the upside, and small caps are part of that.
Mona, we're all conditioned by the recent past, and when it comes to the broadening out, I find myself wondering, okay, is this it? Because we've been hearing this for quite a while, and even yesterday, even though we saw a pop in the Russell 2000, that wasn't the leadership. The leadership, guess what, was Apple, was NVIDIA, were the big tech names that have been leading all along, and actually the equal-weighted S&P 500 significantly underperformed, only gained about 0.5%. Is it too soon to really bank on the idea of broadening out, or do you think that it's kind of now to get in before you really see the whites in the eyes of the turn?
Yeah, we do think that there are two catalysts ahead of us for the broadening. One we mentioned, which is as we get closer to Fed rate cuts, we think that's one potential catalyst for this broadening. But the second is really an earnings story. And we need to see, in the back half of the year, the forecasts show that it is not just those three tech and growth sectors that are leading earnings growth. In fact, for Q3 and Q4, most of earnings growth is coming outside of the technology sectors. And so as that plays out, we do think that that's the second catalyst that will spark at least some meaningful broadening of leadership. Now, what we'd say more broadly in terms of the tech play, because it is a question that comes up quite often, these companies are not only leading the AI charge, which we think has long-term secular growth behind it, but they are also massive in terms of balance sheets. So, of course, in a higher rate environment, they're not tapping the debt markets. They certainly are returning value to shareholders through buybacks and dividends. And by the way, they're getting better returns on their cash as well. So they've almost become the play during the higher for longer environment.
It seems like you think we're either early cycle or mid-cycle, and that's somewhat different than what we've been hearing for the past number of months when people were saying, actually, we're late cycle, we need to see some sort of washout in order to get back to the inflation levels that we wanted. What's changed?
Yeah, I think generally we haven't yet seen the market turn, the economy turn in any meaningful way. Now, I think to your point earlier on the labor market, we're starting to see early signals that perhaps some cooling is in front of us. But we continue to see, rather than an outright washout of the labor market, perhaps a better supply and demand dynamic. And so if we do truly get this Goldilocks soft landing scenario, what could happen is you get more labor participation, more immigration that helps the supply side of the story. And in the meanwhile, the job openings and demand for that labor cools as well. But rather than the unemployment rate massively moving higher, you instead see wage gains starting to cool. And so that is a scenario that is right now embraced by the Fed, probably the base case adopted by the markets. But I think until we see otherwise in the data, it continues to play out nicely as well. And so I think that's essentially what's changed and why we haven't yet seen a real turnover in the economy.
Mona, let's just go through that again. Embraced by the Fed, somewhat adopted by the markets. And one of the issues that you pointed out was immigration, which is highly dependent on what could happen or may not happen in November. And I'm trying to work out, Mona, just how much we're flying blind into 25. We were sat around this table talking about the 2025 projections, and Mike McKee shot me an email, came back on TV and talked to us about it. She said 2025. The outlook for 25 could change so much based on the turnout that we see in November. You get a blue wave, a red wave. You could see this Treasury market sink. You could see some big policies going forward from here. Mona, how much visibility do you have on next year?
Yeah, look, certainly the presidential election will play a key role in the direction of policy broadly. What we'd say is, of course, one, we're still envisioning a Congress that is pretty divided. And so we do think, regardless of who wins in November, checks and balances remain in place. And so any president will have difficulty pushing through major tax reform, major legislation or regulation without the support, fully of a Congress behind them. And so generally that gridlock environment we think remains in place. We know markets embrace gridlock because it gives them, to your point, a little bit more of a transparent operating environment. Also, we've seen historically in a 4-year presidential cycle, from a market perspective, year 3 tends to be the strongest, and perhaps we got that last year. But year 4, the year we're in now, tends to be the second best. And part of that is some of the uncertainty is lifted. Part of it, in theory, is that the administration is putting together a better environment for markets. But broadly speaking, it does feel like ahead of election day, you get some volatility, but in the 6 or 10 weeks after, we tend to see an upturn. And so that market volatility we get could be an opportunity, especially if we're in an environment where the president is a little bit less able to maneuver as aggressively as needed or as he wants.
I remember when we used to think, wow, the U.S. election's got to be a big risk. I wonder if it's keeping people away from U.S. assets. And then we learned, oh, wait a second, the risk is even just greater elsewhere in other nations. How much is the U.S. exceptionalism story ongoing? And how much does it really continue? Or are we seeing sort of a broadening out in that story, even amid all the political risks globally, not just in the U.S.?
Yeah, it's a great call out because I do think we are starting to see some participation and tick up in international markets, parts of EM, parts of EFA, non-developed US, starting to play some catch up as well. Of course, we are in perhaps what is a global rate cutting cycle. We've seen the Bank of Canada and the ECB move ahead of the Fed, 25 basis point rate cuts each. Keep in mind, though, those economies have softened more than the U.S. and their inflation stories have played more catch up as well. So better inflation dynamic, but softer economic growth in the economies that have started cutting rates. We'd say generally the U.S. exceptionalism story probably comes through most clearly in this AI boom that we're seeing. And of course, as we think about the years ahead, a lot of the enablers of AI, that Magnificent Seven cohort, the infrastructure, semiconductor players, all happen to be housed in the U.S. So from a market perspective, certainly seeing the benefits of that part of the economy really playing some true exceptionalism versus the rest of the globe. As we think about, the years ahead, if we start to see those productivity gains and efficiencies start to kind of spread throughout sectors that might benefit from AI, think about financials, manufacturing and industrials, healthcare, those sectors are pretty prominent outside the U.S. as well. So perhaps we start here in the U.S. and we start to see some catch up in the rest of the world in the years ahead as well.
Mona, thank you. Mona Mahajan of Edward Jones breaking down this market in reaction to the data we got yesterday morning and the Federal Reserve decision later on in the afternoon. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Another central bank decision on deck. The Bank of Japan is expected to consider reducing its bond purchases at this week's policy meeting. That reduction would mark the first clear step towards quantitative tightening after beginning to normalize policy back in March. Investors are also on alert for any signals on the prospects for an interest rate hike next month. Economists are projecting the BOJ will hold its benchmark rate between 0 and 0.1% when their two-day gathering wraps up on Friday. Donald Trump is back in Washington, D.C. today. The former president is meeting with leaders of some of the country's biggest companies. That includes Jamie Dimon, Jane Fraser, Brian Moynihan, and Tim Cook. That according to people familiar with the event. During his one-day return to the Capitol, Trump is also set to meet with congressional Republicans. And European nat gas prices this morning jumping to the highest level of the year. There are fears of disruption over what's left of Russian fuel flow in Europe after a recent court decision. OMV, Austria's oil and gas giant, says that they are prepared to replace 100% of supply they might lose from Russia. I spoke with the company's CEO this morning on Bloomberg Brief.
We have been preparing for such events for the last 2 years. We have diversified our supply sources. We have booked pipeline capacity so that at any time we can ensure that we can deliver all our customers also with non-Russian gas in case such a interruption should happen.
Austria does still import more than 80% of their fuel from Russia. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, Trump tightening his grip on the GOP.
This is just another, example of House Republicans bending the knee to Donald Trump. That's just how dysfunctional the House Republican conference is.
That conversation just around the corner. Live from New York, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equity futures on the S&P 500 just about positive by 0.1%. In the bond market, yields unchanged. Your 10-year 431.60. Under surveillance this morning, a tale of two candidates. Here's the latest. Former President Donald Trump meeting with GOP leaders in Washington as he campaigns for a second term in office. Later in the day, he'll attend a business roundtable meeting with key leaders including Jamie Dimon, Jane Fraser and Tim Cook. At the very same time Trump is speaking in Washington, President Biden will be speaking at the G7 in Italy. Terry Haynes of Pangea Policy joins us now for more. Terry, let's do the side by side, the preview. How different are those two addresses going to be?
Well, of course, they're pretty different because one's primarily about domestic policy and one's about foreign policy. I mean, Biden will be doing what he's doing with the G7, talking about Russian assets and how to deploy them to help Ukraine, as you and Lisa were talking about a few minutes ago. And what Trump's doing in Washington today, frankly, is fundamentally is making a pitch to business leaders and trying to show unity with congressional Republicans to show what a 2025 all-Republican Washington might look like. Now, I think that's only about a 30% likelihood at most. The split Congress is a split Congress, and with a tiny Biden advantage is my call today. But even if Trump's president, markets should understand that what brought on the animal spirits in 2016 wasn't Trump being president. It was Congress going all Republican that allowed the 2017 tax cuts to happen. So, the Congress, frankly, here for what markets care about is more important than the president, and that's kind of what Trump's trying to show.
Terry, let's just sit on the business roundtable. We're not talking about any CEO. We're talking about the CEOs of the biggest financial institutions on Wall Street, the CEO of Apple. There has been a question more recently over the last few months, particularly on this program, about how business-friendly a second Trump presidency would actually be. How business-friendly do you think it will be?
They'll try to make it so, and I think it probably would be should it come to pass. Although, as I say, it's not my base case. With a Republican Congress, I think what you get is if you get an all-Republican Congress, just as in 2017, you see the Congress driving things like tax cuts and the policies that business cares most about. They were much more in the driver's seat than Trump was on that sort of thing. I do think that if you see a Trump presidency with a split Congress, though, you're going to see a lot more of what I've been calling recently Mount Trump, where he pushes back against those who don't want to do whatever it is that he wants to do in the Congress. Now, that relates mostly to, I think, fiscal policy and domestic policy. Let's remember that in today's Washington, just as in 2025's Washington, you're going to have an awful lot of unity on foreign policy, all to the good, and you're going to have an awful lot of unity on fiscal policy that, frankly, makes markets feel squirrely because it's more fiscal spend, more debt and deficit.
There's a lot that you said there that I want to unpack, but Terry, this idea that we might hear what a second term of President Trump might look like, what are you listening for, especially when it comes to the business world at a time when a lot of people really don't have certainty around that?
Well, it's a pitch. He's here for a lot of reasons, and just as any politician, you're trying to not only show what you do think, but you're trying to show what kind of reality you'd like to create. He's in the business of showing a couple of things. One, that he's business friendly, and secondly, that he's going to be a kind of a rational actor on a lot of this stuff. And he was on tax cuts. And one of the things that he wants to do is remind people that they'll continue to be a business. He'll be a business-friendly presidency, that he wants them to, and they should want to support Republican candidates in Congress to create that all-Republican reality that allows them more business freedom, less taxes, less regulation, that sort of thing. And he also wants to show, frankly, that he's worthy of being supported financially and rhetorically and every other way, because the reality, again, is he doesn't have a united party, and he's not attracting independents. One way to do it is to show he's clearly differentiated on economics.
Terry, you said that there also seems to be some unanimity on foreign policy at a time where President Biden is at the G7 trying to sort of immunize international policy from elections, given some of the latest moves on Ukraine. How do you square that? What does the United Front in the U.S. look like when it comes to foreign policy and what's likely to come down the pike, regardless of who takes office, but maybe with a greater emphasis with another President Trump?
Well, you're going to have a situation where in 2025, regardless of who the president is, where the vast majority in Congress, and I think the vast majority of the public too, supports current U.S. foreign policy, supports helping Ukraine, supports helping in the Middle East, helping Israel, and getting peace there, helping in the Indo-Pacific, all the rest. One of the things that took so long in getting that aid, though, frankly, is that Biden was not very good, very forceful, pushing very hard to actually get that. It said everything that Biden announced this emergency in November, and yet no one, Democrat or Republican, on the Hill really reacted to it, and it took almost 6 months to clear it up. I suspect what you're going to end up seeing is a lot more urgency down the line, and I think just as last time, Trump largely gets led by Republicans in Congress to create a foreign policy and an economic policy that continues along the same lines. You may see a little skepticism on the margins, but right now I don't think it's going to be that significant.
Hey, Terry. Good to catch up, sir. Terry Haynes of Pangea Policy down in Washington on the latest. Quite a scheduled side-by-side, but given how late either could be, I imagine it's not going to happen precisely at the same time.
Nonetheless, the focus on domestic versus international, very interesting. And Terry is saying that there's quite a bit of consensus and that they'll come together around pretty much the status quo and continuing it. Sort of flies in the face of a lot of the rhetoric that is highly nationalistic that we're hearing globally and that we're hearing here in the United States. So I wonder just how it plays to the electorate. I understand what actually might happen is different than how you play it, but that's what I'm actually curious to listen to.
No, I'm with you. I think you're on the right line of questioning. There is some daylight, some real daylight between what they're focusing on at the G7 today, tapping into Russian assets, and what national electorates are voting on at the moment, based on the outcomes of those votes.
Which is the reason why you really identified how weak all of those leaders are as they stand for the family photo at G7.
Coming up just around the corner, G7 nations agreeing to tap frozen Russian assets. Their conversation just around the corner. Some live reporting from Anne-Marie.
politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
2 hours away from the opening bell, equity futures on the S&P just about positive by 0.1% after closing at another all-time high in yesterday's session. Bremo's counting. What are we on?
28.
28 record highs on the S&P so far in 2024. On the Nasdaq at the moment, we're up by 0.6%. The Russell had a day. Is it anything more than a day? We're down by 0.4%. It's a question I've got. I know you've got it too.
Well, it was a day, but it wasn't that great even compared to the Magnificent Seven because they still were overshadowed. I was looking at this. If you take a look at the Russell 2000, it was up 1.6%. The Mag 7 was up 1.9%. And it was really just Apple and NVIDIA. I mean, people say we don't talk single names. Okay, you don't talk single names. How about the leader in chips? How about the leader in smartphones? I mean, it's basically, we're talking about the same thing.
Look, leader in smartphones and chips, high rates, doesn't matter. Low rates, doesn't matter. Does rates even matter when it comes to these names?
You know, this is what I was thinking. Why did they get a boost from the idea of inflation coming down? What logic is that? Because arguably you could say that their income would actually go down if rates came down, given that their cash piles are now generating 5.5% interest. So at a certain point, really?
Saw some big moves in the bond market yesterday. Let's get you up to speed. So yesterday, CPI drops, 8:30 Eastern time. Yields plummet. See a big plunge lower. Double-digit basis point move right across the curve, particularly on the 2-year. At one point, we were down about 16 basis points at the front end of the yield curve. We gave half of that up. Once the news conference and projections really started to filter out, we started to process that this Federal Reserve really wasn't in a rush to adjust after that CPI report.
Dovish nirvana would have been 2 rate cuts baked in, down from 3, in terms of the statement of economic projections. They only had 1, although with an asterisk. It was a pretty messy kind of combination and mix of different Fed officials. And then you would have had Chair Powell sort of undo some of the hawkish tilt by coming out and saying, actually, we just didn't really incorporate the CPI data and that could change things. He did not. He indicated they had seen it. So this all leads kind of a mush. And then you have people like Wei Li actually came out of BlackRock and she said, you know, the Fed doesn't know anything more than we do. Don't listen to them.
And by the way, there's some reason to believe that maybe those jobs numbers on Friday were overstated.
Yeah, did you like that?
It's quite aligned in that news conference, I thought. Lots of people picked up on that.
Well, the reality is it was confusing to everyone. And he said that he couldn't reconcile it. And they've been very clear about the fact that sometimes they can't reconcile it and they can't create a narrative. But the fact that overstated was the way that he went indicates sort of a dovish lean.
So the euro got a bit of a bump yesterday, some strength. The dollar weaker off the back of all of that, particularly off the back of the move in the bond market. Today, the euro just a little weaker, retracing some of those steps. 107.88 on that currency pair. Under surveillance this morning, Fed officials dialing back their expectations for rate cuts. The median projection now calling for 1 cut this year, even as US CPI came in softer than expected. Another read on the US economy, 8:30 Eastern time. We get PPI and jobless claims. Jobless claims, the estimate in our survey, 225, the previous number 229. Given his comments on the labour market on Friday, just plays into what I think a lot of people already believe, which is this Federal Reserve is willing to ignore what looks like strength, but on any sign of weakness in this labour market, they'll be willing to move and cut interest rates.
And, you know, on the margin, that was kind of emphasized yesterday because the disinflation was really sort of front and focus. And they indicated they'd be willing to cut rates, even with inflation projected to be even higher than they previously expected next year, in the face of labor weakness. And to me, this is really the key. They're still hoping for that soft landing. They still want to land it. And that, I think, is the reason why a lot of people are saying, okay, we're not late cycle anymore. Suddenly, maybe we're mid-cycle. We got some more legs in this rally.
Mike Collins of PGIM joining us later in the program to weigh in on some of this. I want to talk about Tesla just briefly. Shares are rising in the pre-market, up by something like 5% a little bit earlier this morning. Where are we now? Up by 6.8. Elon Musk saying shareholders voted, quote, by wide margins in favor of reapproving his $56 billion pay package and moving the company's official headquarters to Texas. The preliminary results coming ahead of the company's annual meeting in Austin today.
This just crossing reporting by the New York Times Deal Book saying that Vanguard and BlackRock both voted in favor of that $56 billion pay package. So he got some of the big behemoths lined up behind him. Curious to see what the sort of win is in terms of the share pop. Is this essentially that they're not going to get any pushback, or that Elon Musk isn't going to threaten to leave? It's not going to cause more turmoil at the top. What was the consequence if he didn't give $56 billion?
I don't know. It would be a real question mark over whether he wanted to continue leading the company, though, wouldn't it?
I mean, he still has a lot of money tied up in this company. And honestly, that's quite a look if he says, okay, I got $47 billion. No way. I'm out. Peace. I mean, at a certain point, really, can you do that?
My question is, you have to take the character out of this. I understand he can be polarizing, whether you like him or not. Let's just remove Elon Musk from the conversation. And let's just say you've got a CEO of Company X. Maybe not Company X, that doesn't work. Company Y. You know where I'm going with that, of course. Yeah. Company Y, all right? And you say to this CEO, these are your milestones, you hit them, this is what you get. And people sign up for it, they vote for it. And then further down the line, they get to vote on it again. Never really made sense to me.
I hear what you're saying, which is basically, again, precedent. And how do you sort of understand the precedent at a time when this is somebody who is highly polarizing, but it's not sort of a popularity game necessarily. And he is still the founder and, frankly, the face of Tesla in every which way. The key point to me is there is some pushback. There's a question of where his allegiance is. And the bigger question for Tesla going forward is less how much he gets paid and more where he wants to put his chips, literally and figuratively, when he's trying to move out into more of a technological focus.
Over at Company X.
Exactly.
Apparently. All right, let's move on. G7 nations agreeing on a structure to use profits generated from frozen Russian assets to provide $50 billion in fresh aid to Ukraine. Bloomberg's Anne-Marie is on the ground in the south of Italy at the G7 and helped break this story. AMH, share the details with us.
Well, Jonathan, they've been working on months to try to get this deal over the finish line, and they are set to sign off on this today when G7 leaders will be meeting. What they're going to do is tap the future interest of these immobilized frozen Russian assets, $280 billion worth, which mostly sit in Europe. Now, the Europeans had agreed. This has been fraught negotiations for months. The Europeans had agreed to do this on a year-by-year basis. What the United States has been wanting to do is take the accrued interest that they expect from these frozen assets and front-load it now to Ukraine to get Ukraine more money up front and also really election-proof this, meaning by the end of the year, Ukraine would get $50 billion in financing, loans from the countries that are willing to sign up. The issue, of course, is going to be some of the technical details they're going to work out after the G7, but the political will is there, and they plan to go ahead with this. Of course, the big question is, how do they get paid back? So those countries in the future years will get paid back those interests on these frozen assets, but this is a huge win for Ukraine. You remember what Dmytro Kuleba said to you, Lisa, and myself at Davos. He talked about the fact that this was a critical goal for Ukraine for 2024, and that once the politicians signed off on it, the bankers and the lawyers, they'll find a way to make it happen.
And they're making it happen right now. Reportedly, Anne-Marie, great work as always. Anne-Marie Hordern at the G7 meeting in Italy. With us around the table is Stephen Cook of the Council on Foreign Relations. Stephen, good morning to you. It's good to see you.
Good morning. Great to be here.
Let's just talk about the difference between what voters seem to be voting on right now and what leaders seem to be talking about at the G7. How big is that gap at the moment?
Well, it seems to be a very big gap. I mean, Americans in particular are concerned with the southern border and issues here in the United States, whereas once again, the G7 are proposing to shovel lots of money in the direction of Ukraine. There's a case to be made for this, especially since these are Russian assets, but that's not the way it necessarily is translated among the American people. So the president, people in Congress need to make this case, and they don't seem to be making it.
What's the consequence of the greatly weakened nature of a lot of the leaders in G7 as they talk about some of these foreign policy initiatives? Is there any historical analog that you can draw back on for guidance on how this is going to transpire and how it's going to shape policy?
Well, the weakness of the G7, the weakness of the West in general, has encouraged people like Vladimir Putin, the Iranian leadership, to press their advantages in different parts of the world. When the United States has demonstrated weakness, particularly in the Middle East, the Iranians, now partnered with the Russians, have pressed their advantage. The chaos that we're seeing in that part of the world, the attacks on Ukraine that are unrelenting but have been fallen off the radar screens, are things that are dangerous to the Western political order. And we have a bunch of weak leaders who have been unable to make the case to their people.
Donald Trump has argued that under him, none of this would have happened. And some people say, you know, maybe that is a bit of a stretch. There still were tensions under his rule as well. But other people have had some criticisms of President Biden's approach. What's your take on how he's countered sort of the growing unity of some of these nations, Iran and Russia in particular?
Well, count me as one of those skeptical of President Trump's argument that none of this would have happened under his leadership. I do think that President Biden was dealt a weak hand, particularly on Ukraine, and has in general held Europe together on that, despite the tremendous opposition within the U.S. Congress on Ukraine. The Middle East is somewhat of a different story. He has wavered in his support for American allies, particularly Israel. I mean, there has been tremendous amount of bloodshed here, but the way in which the president has sort of tried to cut deals and navigate between different political pressures here in the United States has essentially weakened the American hand in the region. And that's not what, not only the Israelis, but also the Saudis, the Emiratis, the Bahrainis, and other partners of the United States, they want to see a strong hand against the Iranian malevolence in the region, which, of course, this horrible war in the Gaza Strip is all about.
So your book, the title, I want to borrow the phrase, The End of Ambition. Can we talk about that a little bit more? Do we have this reluctant hegemon? Is it tempted by isolationism? What is it all about right now? What's taken us down this particular path?
Yeah, after a period of about 25 or 30 years in which the United States engaged in this very ambitious plan to transform the region, there is a sense within, especially the American foreign policy community, but I also think among the American public at large, that the United States should withdraw from the Middle East. The investment wasn't worth it. And what the book says is, actually, there is an investment to be made in the Middle East, but not to transform the region, but to laser focus on what is truly important to the United States in the region.
What is truly important to the United States in the region? Because there are some people sitting at home at the moment, many, you see it in polls, they just look at what's happening abroad, they look at the G7, they look at the things they're talking about, and they say, this world order does not work for me, I'm voting for something else. What should the focus be?
Yeah, well, I lay out in the book 6. I won't bore you with the 6, but a number of them should be familiar to people, including the free flow of energy resources out of the region. Everybody remembers the price spike of gasoline at the pump in 2021 and 2022. Middle East is very, very important for the free flow of energy resources. Continuing to help secure Israel is a very important thing to many Americans. Counterterrorism, especially in this moment of turbulent world politics, and of course, non-proliferation. These are all things that remain important for the United States and things that the United States should invest in. Not remaking Iraqi society, not promoting democracy in countries where leaders are going to resist that and where we can't achieve those things. The 4 things I just mentioned are things that are actually achievable.
More pragmatic approaches rather than ideological ones, I think is
Absolutely.
one way of putting this. We were just speaking with Terry Haynes of Pangea Policy, and he was saying, actually, there is some unanimity when it comes to sitting Congress members in terms of maintaining some of these relationships and the U.S.'s international footprint. Is that true? Is that your take on it, too, given the fact that the rhetoric seems to be pretty much at odds with that?
Yeah, Washington is deeply, deeply polarized. And I think the war in Ukraine is something that has really exposed those rifts. I think by and large, people want to maintain those relationships, that the United States is a global power, but there are questions remain as to how long and how open-ended the United States support for Ukraine, which is not a NATO member, is going to be. From my own perspective, we should continue to support Ukraine because after Ukraine, the Russians will set their sights on actual NATO members. That we really need to actually, to use a terrible cliche that people use in Washington, draw a line in the sand when it comes to Ukraine.
Are you convinced they will, that they'd go after NATO members? They'd test that line, they'd cross it?
You know, it's hard not to take Vladimir Putin at his word in these speeches that he has given in the past about essentially the recreation of the Russian Empire should be taken seriously. No one took, on the eve of the invasion of Ukraine, both in 2014 and in 2022, no one took it seriously And yet he moved against Ukraine.
It's very true. Stephen, it's good to see you. Thank you, sir.
Thank
Stephen
you.
Cook there of the Council on Foreign Relations. So let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Boeing is set to face FAA scrutiny for the, quote, foreseeable future. That, according to prepared testimony seen by Bloomberg. The agency is set to place more inspectors at Boeing's facilities and at supplier Spirit Aerosystems. Boeing will face a hearing today in Washington after multiple safety concerns emerged about its planes since a January 5th accident that saw a fuselage panel blow off. Sony has acquired theater chain Alamo Drafthouse, who pioneered the in-movie dining experience. Terms of that deal were not disclosed. The acquisition comes as Hollywood box office revenues and national theater audience struggle to recover from the pandemic. Alamo Drafthouse is North America's 7th largest theater chain, with 35 locations across the U.S. Smaller private credit funds are struggling to fundraise. The latest figures show that the big funds keep getting bigger, as fundraising as a whole last quarter was at its lowest since 2020. That, according to Preqin data. I spoke with $31 billion debt manager Arcmon and asked its CEO if that means more consolidation is on its way.
Yes, I think it's inevitable. I think as the asset class has matured and essentially grown up, one thing is absolutely clear, that LPs, investors, want players with size and scale. Investors are looking for scale players. I think also the larger players have managed to do larger deals, which by and large are safer deals. So that's also reflected in better portfolio performance. And you are seeing really a significant number of consolidation events.
Anthony Phobel spoke with me on Bloomberg Brief, which is every weekday at 5 a.m. Eastern. And that is your brief. John.
I watch it religiously, Danny. You know that every morning. Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the fine line between 1 and 2.
The difference between two-cut and one-cut median is 1 member. This is a very fine point to be seeing, pretty big shifts in market pricing.
That conversation up next, live from New York. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a quieter session, let's put it that way. Equities are just a little firmer by 0.1%. Bond yields are basically unchanged at 431.41. A little bit of price action in the commodity screen. Crude's down 9/10, 77, 76. Under surveillance this morning, the fine line between 1 and 2.
The difference between two-cut and one-cut median is 1 member. This is a very fine point to be seeing, pretty big shifts in market pricing. I think the broader theme here is this is still a Fed that is looking to cut rates very supportive to financial markets. I think this is a pretty good setup here for bonds and stocks.
So here's the latest. Treasuries holding steady after a volatile day of trading sparked by cooling inflation and a hawkish Fed tilt. The central bank penciling in just 1/4 point rate cut this year, but investors still favouring two. Michael Collins of PGIM Fixed Income joins us now for more. Mike, in many ways, the median sort of masks the division, the split on the FOMC. How fine a line is it between 1 and 2 for this year?
You know, Jonathan, it's really a coin toss. I mean, I don't think that's a big deal at all. I think the markets and even the media are making too big of a deal of the difference between one or two. Remember, before yesterday, the Fed had penciled in basically over the next 3 years, 3 cuts this year, 3 next year, and 3 the following year for a total of 9. Now they penciled in 1, 4, and 4 for a total of 9, right? They get to the same place in 3 years. I mean, if anything, the potential mispricing in the market is what's ultimately priced in, right? The markets are only pricing in 7 cuts over the next 2 to 3 years, not the 9, and stopping there. And remember, the Fed's long-term dot, even though it's gone up, it's still 2 3/4, right? And the markets are almost 100 basis points above that. So in the near term, again, the difference between 1 or 2, I don't think it's possible to make a lot of money trying to bet one way or for or against that. But over the long term, as Jeff Rosenberg said, you know, bonds are cheap.
Bonds are cheap because you're expecting more easing here, Mike? You're expecting the Fed to deliver what they're signaling?
Over the long term, I don't think they're going to stop at 3 5/8 or 3 3/4. I don't think they're going to stop, after 7 cuts. That's what the markets are telling us they're going to do, right? The markets, John, effectively have priced in a permanence of this higher growth, higher inflation, and higher rate world that we're living in today. The markets are really discounting the possibility that you have 300 basis points of rate cuts at some point in the next 5 or 10 years. And I'll bet that there's a higher probability that the Fed cuts more aggressively at some point in the future than this really sanguine view the market has.
Mike, let's dig into that a little bit more. Why do you think that is? Because you think that the economy is weakening much more significantly than people expect? Or do you see on the other side that normal looks similar to what it did before the pandemic?
Yeah, I mean, I just think the high growth. Look what's happening in Europe and the UK, right? They're cutting rates, and Canada, their growth rate in Europe and the UK, Lisa, since COVID is 0. They have not grown at all. They've just recovered back to where they are. Obviously, the US has been the shining star in the global economic picture. And yeah, maybe that's sustainable. Maybe the AI and the productivity boom associated with that is sustainable. But I do see, a lot of challenges, among consumers, a lot of challenges among small businesses. I think all this wealth creation, and the benefit of higher rates and the benefit of high home prices have really gone to a small portion of the population. And I think the higher these rates, the longer these rates stay high, I think it really does weigh on demand. And you're seeing that, right? You're seeing consumers trade down. You're seeing businesses start to push back on some of their capital investment because of the higher rates. Financial conditions are easy, except for the rate part. The rates are too high. And Powell admitted that yesterday. He admits rates are in really restrictive territory, and he needs to cut them eventually. And I'm just in the camp that, the funds rate is probably going to average, 3 or 3.5, not, 3.5 or 4 over the next 10 years.
So, Mike, right now we're looking down the pike at a 1 p.m. $22 billion auction of 30-year notes. You say bonds are cheap. Are you going to be there basically shoveling up as much as you can?
Well, we've had a big rally in the near term here. I think it does make a little sense tactically if you could trade rates really tactically like we can to maybe even take profits on this big rally. I mean, rates have rallied 40 basis points really quickly here in 10-year space. And so in the near term, there may be a little bit of a challenge digesting some of these huge auctions. Obviously, the 10-year went great. But again, over the long term, you look where our rates are versus Europe, right? We're still almost 200 basis points above Germany. We're 350 basis points above Japan. The world, the central banks and the big pension and insurance companies and financial institutions around the world need yield. They need fixed income, and our markets are just stand out to me as being really attractive.
So tactically sell, strategically buy. Just so I'm super clear, Mike.
Yeah, I think tactically, we're a hair short in some of our duration in some of our portfolios right now, just on the view that the Fed has historically dragged their feet on taking action, right? That first move is a big one. Powell mentioned that yesterday, right? The first move is a signal, and the markets tend to run with that. And I don't think the Fed wants the markets to get too far ahead of themselves in terms of easing financial conditions even more, right? So I still think there's a decent chance that zero rate cuts comes into play this year. So we're kind of fading, the two that the markets are pricing in a little bit here. But wow, if you're a real, long-term investor like we are, and most of our clients are, Jonathan, and most of the people in the world really are, you're supposed to own more fixed income. It's really in the sweet spot, and there's a lot of value.
I got it. I'd love your thoughts just finally on this. I got this note from BNP Paribas just months ago. It came from Yelena Shuletseva, former colleague of ours, good friend of this program, who said, November, first move potentially in September, but presidential election uncertainty would argue in favor of waiting until December. November is the month where there seems to be an issue for people, Mike. What do you make of that this Federal Reserve would be thinking about the outcome of November and would rather wait until the back end of this year to see how things work out?
Yeah, that's part of the problem, right? They're running out of, they have 4 dates left, right? And a lot of people are just discounting July altogether. September is only 6 weeks before the election. And, I really think you need to see the data shift pretty abruptly from where it is today. You need a much more decisive reason to cut rates 6 weeks before the election, just as a real, because of the potential political blowback. And obviously November 7th is 2 days after the election. There's a good chance, Jonathan, that we don't know the results of the election at that November Fed meeting, right? Is the Fed going to want to cut rates when the result of the election is hanging in the balance? I don't know. So you're really running out of dates, which is why I think, heck, there's probably an equal chance of zero cuts this year as there are 1 and 2.
True. Mike, thank you, sir. Mike Collins of PGIM, fixed income, plenty to think about. Might not be settled in November. Might have to wait for runoffs. Remember, the Georgia runoffs didn't take place until, what was it, early January 21.
Yeah, we heard about that from Amy Silverman talking about some of the derivatives action. My takeaway from this, and a lot of conversations that we've been having, is that essentially people like bonds once the Fed starts cutting. So basically everyone's treading water before really seeing the sign that they're actually going to make that move. And then can you imagine, let's take a poll of what kind of rally we're gonna see. How many basis points of a just absolute plunge do we see in yields pretty much across the curve?
Forgive me for being on the fence, but it really matters what the backdrop is. So is this a mid-cycle adjustment, or is this like unemployment surging and the rate cutting cycle starts? Because if you listen to what Mike's got to say, and I'll throw in Mike Schumacher of Wells Fargo, they're thinking about the same thing, that when this Fed cuts, it's going to be a cycle. It's going to be deeper than you think it is because they're going to be confronting real economic weakness. That's their call.
And if they don't cut rates this year, the Fed, how much deeper could those cuts be next year, right? I think that that's what a lot of people are trying to crystallize in their minds.
We've got a lot to talk about. We'll do that in the next hour. Joining us is Gargi Chowdhury of BlackRock, Bloomberg's Craig Trudell. The latest with Tesla with that stock up big time at the pre-market. We'll speak to SocGen's Subhadra Rajappa and Jonathan Pingle of UBS from New York. The third hour of Bloomberg Surveillance. Up next.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. How does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
This is a Fed that focuses excessively on the past and doesn't want to signal much about what's ahead.
Central bankers don't shout mission accomplished.
They are very deliberative right now in terms of not getting too far ahead of themselves until the data comes to them.
The data is probably more important than the dots in this case.
This is still a Fed that is looking to cut rates, very supportive to financial markets. So I think this is a pretty good setup here for bonds and stocks.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
There's certain things as a broadcaster you enjoy doing, you don't get to do very often anymore. Tiger Woods leading the US Open. I get it, he's played one hole and not everyone's teed off just yet. But he leads the US Open at 1 under. One hole played. But you know, come on, it's Tiger Woods. I can enjoy it just a little bit, just for a moment.
I'll sit there with you. I'll enjoy it. Okay, done.
Scotty Scheffler a little bit later with Xander and Rory teeing off at about 1:14 Eastern time.
Okay, to be completely honest, I don't follow the actual game, but the fact that Rory's getting back with his wife seems like a big deal.
There you go, you see.
Yeah, that I can kind of get into.
Some news you could use this morning.
Big time.
All right, quite a session in the market. You can tell, can't you? From New York City this morning. Good morning, good morning. Equity futures on the S&P 500 positive by 0.1%. Plenty of reaction to the CPI data of yesterday morning and the Fed decision in the afternoon. This from Citi's Andrew Hollenhorst just moments ago. It's about the data, it's not about the dots. So let's talk about the data. Have we learned over the last couple of months that basically the Q1 inflation data was a bit of a head fake, Bramo?
Well, that's really what people are leaning into. Let's just go over what we got yesterday at 8:30 a.m. Eastern. We got the slowest month of core inflation since August 2021, so that really shows progress. On a year-over-year basis, when you look at core CPI, it came in at the lowest level going back to April of 2021. So really, you could see this just grind lower. To your point, a lot of people embracing this as the disinflation that was delayed, not just taken off the table entirely.
So Team September still thinks the door is open, but this is what Team December's got to say. You following? I hope so. This is what Yelena Shulateva's got to say. I mentioned this from BNP Paribas months ago. I think it's worth sharing again. We continue to expect the first cut in December, even though progress on inflation could imply conditions for a first move in September. Here's the key line. Presidential election uncertainty would argue in favor of waiting until December in their view. How important is that this year?
Can I just say how remarkable it is that we are baking in the understanding that this could be, or very likely will be, a contested election that will go on for longer than one day? I mean, that's the base case right now for markets is rather shocking. And yet here we are, and people are trying to understand how to bake that into their assumptions. A lot of people agree with her. Basically, this is a fraught moment. So here's my question. Does this make it actually more likely that the Fed will cut more deeply in 2025? Or does this basically just delay the same rate cutting cycle that the Fed otherwise would engage in? In other words, how much does it weaken the U.S. economy to have the Fed on hold for a longer period of time than maybe the data would warrant?
So I don't have a base case, because I think it's tremendously difficult to establish one for 2025.
That's
what
fair.
I sense from market participants is what they're doing at the moment is pretending it's not happening, extrapolating out current trends, and then they'll think about it once we get to November. Do you have a split government? Do you have a blue wave or a red wave? Do you have conditions that change things markedly in 2025? Super, super hard to forecast, but we have to do the scenario analysis, and we did a few weeks back. Adam Posen of the Peterson Institute making the case that you could see some quite remarkable policy changes on the trade side, on fiscal impulse, that could lead to conditions where this Federal Reserve might have to consider hiking. Now, again, that is super, super contrarian, but that's a view from Adam Posen, and people are thinking about those kind of things. Things could change a lot in 2025.
This is why I actually think it's rather significant that a lot of business leaders, financial leaders, are meeting with Donald Trump today, because there is this feeling in the market that Donald Trump would be sort of the change agent rather than President Biden, considering that he's already been in office for 4 years, and that if he were to come to the fore, he'd be very cognizant of the market's response to any of his proposals. So that would be sort of the gut check on anything that he would do. I'd be curious to see what the tone is with some of these business leaders, because that's ultimately what a lot of people are saying is keeping a lot of those expectations in check. Ultimately, markets will have the final word. That remains to be seen.
You'll hear from the former president a little bit later on today. Equity futures on the S&P, your scores look like this on the S&P 500, adding some weight to yesterday's all-time high. We're up another 1/10%. In the bond market, yields just about unchanged at 431. The euro not doing much, a bit weaker over the last hour, 107.83. Coming up this hour, we'll catch up with BlackRock's Gargi Chowdhury with stocks at record highs. Bloomberg's Craig Trudell as Tesla shareholders vote on Elon Musk's $56 billion pay package, and Subhadra Japa of SocGen reacting to PPI and jobless claims data, which drops in about 25 minutes' time. We begin with our top story. Stocks trading at all-time highs after inflation cools and the Fed leaves rate cuts on the table. BlackRock's Gargi Chowdhury staying constructive on equities, saying this: while the macro picture has been a bit uncertain, the strong earnings we've seen from quality companies keeps us convicted. Gargi's with us around the table. Gargi, good morning.
Hi, good morning.
Not going to ask you about the politics. I'm sure you feel good about that. Not even going to ask you, first of all, about the Federal Reserve. We'll get to that in a moment. Do you think that some of the trends you see that make you constructive on equities are independent of all those things put together?
I think so. I think when we look at earnings for the entirety of the year, you see the companies that have the strongest balance sheets continue to be able to throw off cash flow, and those are the companies that are leading. Not every day. Obviously, yesterday we had a little bit of a small cap bounce, and I think we can continue to see pockets of weaker balance sheet companies having catch up. But if you look at a sustainable period of time, if you look over the next 3 to 6 months, I think quality wins out.
That's leading to market concentration, as you know. Should I be concerned about that? Should our audience be worried about that?
I think that obviously whenever we see gains led by a few companies, we get scared about what that might sort of allude to. But I think broadly, if those companies also tend to be companies that actually are showing profit margin, that they're actually showing a huge amount of cash flow and very low leverage, we think that's a good sign. Now, what we're telling our clients to do is to have quality at the core of their portfolio and then go to a few other areas of the market that have not participated as much, be healthcare, some high quality parts of financials. Even right now, we're kind of thinking about, sort of infrastructure and utilities as other ways to play for the catch-up trade.
Did yesterday change anything for you?
So yesterday was a fun day. I think hearing from Chair Powell, seeing the one dot was a little bit of a surprise, given that the data hasn't meaningfully shifted in a hawkish direction since we last heard from them. So to see 3 dots in the April meeting and 1 in the June meeting was very surprising. But did it change anything for me? I think what it did change was a recognition that this is a Fed that's going to remain data dependent, just like they didn't overreact to the stronger inflation data in the beginning of the year. They're not going to overreact to the weaker inflation data. And I think what this means is we have a pretty stable Fed chair at the helm, which I think is a good sign.
A lot of people taking this as bullish. We've heard that consistently from a whole host of different guests, that this basically means risk on. They're going to have your back, essentially a Fed put. If there's weakness, they're going to respond to it, just like what you just said. How much do you lean into the idea that once they start with cutting rates, it will be a cycle, it will be deeper, and it will be something that will ratify what Mike Collins just said, which is bonds are cheap?
Bonds are cheap, especially front end of the bond market, definitely throwing you a lot of really amazing income. So I think investors should take opportunity off that. But I'd also say that when we think about broadly what the Fed is trying to tell us, they're trying to tell us that they're keeping all optionality open and they really want data dependence, whether or not the market believes that. So in 2025, and this is not the base case, but if we begin to see inflation pick up again, will this be a cycle of cutting rate? No, maybe they pause again. They can start this year, they can start as early as September, maybe December, cut rates a few times, and pause again if inflation doesn't allow them. So what I feel very comfortable about is this is a Fed that's going to remain data dependent and not overreact on one side or the other, which with the strong growth that we're seeing is actually very good for markets, both bonds and equities.
You mentioned the front end of the yield curve. Can we talk about the complete yield curve?
Yes.
Still deeply inverted, negative 40-something basis points, the 2-year versus the 10-year. Have you got an argument for why people sitting at the front end right now should consider going further out along the curve for less yield? What is that argument at the moment?
So the argument right now is if you're sitting in cash, do step out of cash and sort of start buying some of these very high quality assets in investment grade credit, in CLOs, in even certain pockets of high quality, high yield and treasuries, but keep your duration to about 3 to 5 years. I think that is the argument. Step out of cash, step out of 6 months, go out to the 3 to 5 year. There isn't really a meaningful argument to extend duration further than that, given, to your point, the shape of the yield curve. Now, the argument could be, in another world, that growth is decelerating meaningfully and you need that flight to quality bid for duration. We're not in that world right now. Further, given the pressures on fiscal that we're going to have regardless of the election outcome, I think that brings into question why don't we have enough term premium in the yield curve? And at some point, if the market begins to price that in, you're better off, again, in that belly of the yield curve.
It kind of is concerning to me that so many people are going to be really reactive to all of the data and the Fed proclamations, not because I think they're wrong. I think that probably that is the way to go. But does that increase the fragility of markets, that there's huge floods of cash that potentially can shift around all at once? That essentially this is a market waiting for a catalyst, and then you will see that just absolute flood of cash that could overwhelm, frankly, markets that look liquid, but a lot of people are arguing are less than under the surface. Does that type of volatility concern you at a time where bond yields already are swinging around quite a bit?
I think that I don't think concern is the right word here. I think it's something that we have to be thoughtful about. I think when you look at the availability of cash, the $6 trillion of cash that's sitting in the sidelines, that's not a risk-off move. That's asset allocation. People are sitting in cash because you're earning 5.375%. It's not what it used to be, where you're sitting in cash because you're worried about some big event that's going to happen. So I do think we have to think about that as asset allocation, and then think about, okay, what are some risk events that might need to get out of the way before people feel good about investing? One is certainly the Fed. What we hear from clients is people love fixed income, waiting to invest, but waiting for Fed to get out of the way. Well, when and if that happens, there's going to be that cash, but I think that's worthy. That makes sense. Similarly, election is a concern, and obviously we can see some volatility going into October. I think once we're done with that event risk, whenever that happens, we can see investors moving out of cash. Again, we think to high-quality equities.
I'm so pleased you said that. There's a massive difference between T-bills and chill and T-bills and tin hats. Like, this is T-bills and chills. It might be T-bills and tin hats later on this year. I've got no idea, but that's not where we are at the moment.
I love it. It's an asset allocation choice, and it doesn't look like a terrible choice when it's 5.5%. And you just get fund manager after fund manager trying to argue against that, but saying, like,
reinvestment risk.
I kind of get it, though.
Reinvestment risk.
It's getting harder to make that argument.
And then every time the Fed meets, they just sort of drop the dots a little bit more and push out the rate cut call. It's getting difficult to convince people.
Yeah, although I wonder what happens when that flood of cash happens. I mean, again, how much could yields possibly go down? Are we looking at a 0.5 percentage point decline in one day? I mean, just think about who's going to even let go of their bonds to sell them at that moment, given the sort of rush into fixed income.
So here's the important piece of that. So it's T-bills and chill now, right? Because you get yield. T-bills and tin hats is a very, very different story. You could accept even less yield at the front end of the yield curve and still be in cash because you're worried about what's happening elsewhere.
Yeah.
That's why it's a really difficult call to make. A rate's coming down because things are scary. A rate's coming down because we've got disinflation, that immaculate disinflation story. Then that cash gets distributed elsewhere. It's a very different story.
Notice that no one's going to really try to work that out. They're just sort of saying,
I know.
in the next 6 months, this is what's working, and it makes sense. I get it.
You just sort of extrapolate out where we've been in the last 5 minutes.
I mean, what else can you do?
6 to 12 months, I mean, that's kind of it. Equity futures right now recovering as Bramo speaks, which is rare. Equity futures positive by 0.2%. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. G7 leaders have agreed on a plan to tap frozen Russian assets to provide Ukraine with $50 billion of fresh aid, that according to people familiar. After months of discussion, the plan is set to win the backing of leaders at the summit in Italy this week. The structure of the loans would reportedly be based on the size of individual economies. The nations would then give loans to Ukraine and would be repaid using the profits generated by the roughly $280 billion of blocked funds, most of which are immobilized in Europe. Apple isn't paying OpenAI to use its chatbot. Apple believes that promoting ChatGPT to its users is of equal or greater value than monetary payments, according to people familiar. The iPhone maker revealed a partnership with OpenAI during its Worldwide Developers Conference this week. At the time, they said ChatGPT will be offered for free on Apple's products. Apple's deal with OpenAI isn't exclusive, and the company is already discussing offering Google's Gemini chatbot as an additional option. Manhattan rents slipped for the month of May. According to data from Miller Samuel and Douglas Elliman Real Estate, rents were down 3.33% year over year. The median rent coming in at $4,250 per month. New leases, though, were up 41% from a year earlier, but helping to keep prices down, inventories also climbed about 28%. And that's your Bloomberg Brief. John.
Danny, thank you. 42.50 is still just ridiculous. I know we said that already this morning, but 42.50 median rent in Manhattan.
Yes. Well, I mean, honestly, this is what you're looking at. The fact that that's actually a step down from what it's been gives you a sense of just how far we've come.
Yeah, and as we said earlier, that's kind of the division right now between policymakers at the Federal Reserve. In the White House, so we're talking about inflation stabilizing and coming down, things are getting better, and everyone's looking around and saying, yeah, it's still expensive.
Yeah.
Still 42.50.
Well, that's the thing. I mean, when people strip out healthcare costs, they strip out home improvement, and they strip out what you pay at the grocery store, and they strip out what you pay for your kids' education. It's like, everything else you're doing great.
Up next on this program, the morning calls and Bloomberg's Craig Trudell on Tesla CEO Elon Musk's record pay package, and a special thanks to Gagi, because Gagi, I don't think I squeezed that in. It's good to see you. Thank you. Tesla up by 6.5%. You're opening about 1 hour and 15 minutes away.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
The opening bell, 1 hour and 12 minutes away. Equity futures positive by 0.2%, looking to add some weight to that record-breaking rally over the last 3 days or so. Let's get you some morning calls. First up, Deutsche Bank resuming coverage of Nike with a buy rating and 115 price target. The analyst saying the company is ramping up innovation ahead of the Paris Olympics and can gain back shelf space. That stock is just about unchanged in the pre-market. Next up, Barclays boosting its price target on Broadcom to 2K. The analyst keeping an overweight rating, saying it remains one of the best ways to play AI. That stock is up 14% in the pre-market. And finally, Wedbush maintaining an outperform rating and 275 price target on Tesla. Analyst Dan Ives saying the shareholder approval of Elon Musk's pay package and move to Texas removes a $20 to $25 overhang on the stock, with positive in the pre-market by 6.5%. Joining us on that story is Bloomberg's Craig Trudell. Craig, big day for the likes of Elon Musk and Tesla shareholders. What are we likely to hear a little bit later?
Yeah, based on a late-night Musk X post, we're going to get good news on the fronts that you just referred to. The most important one, really, for shareholders has to do specifically with Musk's pay package, which was arranged in 2018. He hit all of these, sort of moonshot achievements that, the payout was incumbent upon him, hitting those goals in order to get the stock options lined up for him. The issue, of course, was that in January, this got thrown out by a judge in Delaware. And so this is an effort to kind of bolster the case for undoing that ruling or challenging it in the courts. It does not mean that, after today, Musk, goes home from this meeting with his stock options, but it is, a shot in the arm for him and potentially for the board as they, fight this and take that fight to Delaware.
Dan Ives mentioned that overhang on the stock. He said it's been a $20 to $25 overhang on the name. Lisa asked this question earlier this morning, Craig, and I think it's the important one to ask. This feels like this morning, as you were, if the votes go his way. What would have changed if he'd lost this vote?
Yeah, I mean, I don't know how you possibly put a price or a dollar amount to just how much this was keeping the stock down. And I think some other analysts who have opined on this really sort of describe it more so as avoiding what would have been a really dramatic drop had the vote gone the other way. And that makes more sense to me, right? Because Musk, if he leaves the picture, this is not remotely a stock worth as much as it is now. I think the fundamentals of the company, absolutely, have been going in the wrong direction, and that has also gotten lost in all of this attention on whether or not Musk is going to stay or go, and his sort of threats to, take AI elsewhere unless he gets 25% control of the company.
Craig, the market's trying to quantify how much the chance of him not getting that $56 billion bonus was. It's about 6.6%. That's at least where we are pre-market in the stock trading for Tesla shares. I am curious, though, to that point of where his focus is. How much does this mean that Elon Musk is going to take the chips from X or some of the other companies and try to find a spot for them in the actual Tesla vehicles, which is essentially the great hope of a lot of these bets in this company?
Yeah, I think it's interesting. Tesla IR spent some time recently with JP Morgan, which just put out a report yesterday, sort of trying to address some of these very questions of just what to make of those threats. And there was an attempt on the part of Tesla IR to kind of separate, well, XAI the company that is closely tied to X, is working on, stuff more so like chatbots, whereas with Tesla, this is, quote unquote, real world AI of trying to get, cars that are out on the road to a point where they're able to drive themselves, and really trying to kind of, separate those two. But the fact that he's, devoting time and attention to standing up yet another company over the last, year or so, after already, kind of taking his eye off the ball and acquiring Twitter, and, the effect that had on the company and the stock, this is precisely, what leads to some shareholders saying, this pay package didn't work. It didn't ensure that we had his attention, and that was already an issue before he went out and bought Twitter and built up XAI, but it's only been exacerbated as a result of those moves.
Craig, a lot of people might argue it's sort of a distraction that Elon Musk is here fighting whether he can still get his $56 billion pay package. I'm a little surprised he's not in Puglia, in Italy, talking to some of the leaders down there who are talking about potentially putting tariffs on his vehicles that are made in China. At what point does he need to get on a plane and get over there to try to figure out how to get a couple carve-outs to make sure that he's not penalized in tandem with some of the Chinese auto manufacturers?
Well, there's good news on that front in that Tesla was the lone manufacturer called out yesterday when the European Commission announced those tariffs as potentially, being able to be assigned a different tariff rate than other companies. And, it required quite a bit of paperwork, we're told, to try and, make the case to the Commission that they were, that they received less state support than some of these other companies. And, the way in which the Commission arrived at these rates was based on the level of subsidization. So they need to make the case to the EU that, hey, we haven't made, as much off of subsidies as, say, a BYD or an SAIC or a Geely, and therefore don't hit us with this, 21% rate that will come into play around July 4th. We should be subject to something lower than that, but that would not be relief that they would feel until later this year, around November.
Craig, just quickly, what did you make in the difference of approach from the Commission versus, say, the government here in Washington?
Definitely more surgical and based on more of a process. I don't necessarily get the sense that the tariff rate that the Biden administration has put on Chinese EVs, was a sort of scientific, calculation. It was essentially, let's take this as high as we can possibly go.
That's what it felt like. Craig, thank you, sir. Craig Trudeau of Bloomberg in London. Surgical in Europe, sort of laborious process, as you might expect out of the Europeans. Lots of bureaucracy and paperwork. Got to apply for this, apply for that. And in America, just big hammer, just saying, nope, 100%.
Right, basically the U.S. saying, we don't want your electric vehicles. And Europe saying, kind of, maybe we do, but I don't know. We just want to make sure that our companies can deal with it. And, we'll work with you, and let's take a look at what oversupply really means.
It's kind of bizarre when the headlines were coming out the last couple of days. Tesla, by the way, in the pre-market, as Lisa mentioned, up by 6.8%. Coming up next, PPI data and another round of jobless claims. The reaction from SocGen's Subhadra Rajappa and UBS's John Pingle. Looking forward to their reaction. And a little bit later, we'll catch up with Anne-Marie on what you can expect out of the G7 in Italy a little bit later on today.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Seconds away from some economic data in America, 1 hour away from the opening bout. The scores look like this going into PPI and jobless claims. Equities on the S&P 500 positive by 0.25%. A lift on the Nasdaq, up by 0.75% on the Nasdaq 100. For a single mover, Tesla doing nicely in the pre-markets. It looks like the vote is going Elon Musk's way ahead of that meeting today. In the bond market, yields on a 2-year at the front end of the curve, aggressively lower yesterday, down again today by 2 basis points, 4.72. With some economic data, here's Mike McKee. Good morning, Mike.
Good morning. Well, for those thinking maybe just one cut this year, don't know. Initial jobless claims come in much higher. 242,000 after 229,000 last week, unrevised. We'll check the revision on that. Continuing claims at 1,820,000. Those are up significantly from the 179.2 that we saw the week before. Now, PPI comes in down 0.2 on the month, and the core comes in flat, as does ex-food and energy trade. The extra core we get with PPI also flat, so that leaves us at 2.2%, same as last month for the final demand headline year over year. Now remember, PPI went up significantly last month, 0.5% during the month, so holding at 2.2 is good. 2.3 for core, down from 2.4, and 3.2 for the ex-food, energy, and trade. That's up from 3.1, so we get a little bit of, I guess, a base effect there. But what we're looking at is jobless claims going up, the labor market maybe weakening a little bit, and PPI going down, inflation going down. I think, you know, the obvious first question to your people around the table here is, are you going to change your Fed call again from yesterday? Since now things are meeting Jay Powell's criteria.
What I'd love to know, Mike, is if the FOMC had this data together with yesterday's data, how those forecasts might change. This data just a little bit more freezing cold water to throw over the dot plot we got just yesterday. Check out the price action. Equities positive off the back of this on the S&P 500, on the Nasdaq, on the small caps as well. We're up by 0.4% on the S&P, up by 0.9 on the Nasdaq. In the bond market, quite a move at the front end of the curve this time yesterday following that downside surprise on CPI. Down another 7 basis points now, 467.80 on 2s, call it 468 on a 10-year, back in the 420s, 425.58. Put it all together, Lisa. Downside surprise on CPI, downside surprise on PPI, wrong kind of upside surprise on jobless claims, and the tone of that data together with the tone of the outlook from the Federal Reserve is even more difficult to reconcile.
Well, it seems like the Fed certainly being more cautious than anything else at a time where the data certainly does seem to be shifting. If we do want to play narrative table tennis, as you put it, as others, James Athey put it, this is additional confirmation that the disinflationary trend is underway and that the core PCE will, if you just grind it through the sort of data grinder, will come out lower, and that will give the Fed a chance to potentially cut. This, though, is the messiness of this. When you strip out food, when you strip out energy, when you strip out trade, the inflation actually creeped up on a year-over-year basis. So there are some real questions under the hood. That said, definitely some positive progress.
Mike McKee is going to stay around the table with us. Let's introduce Subhadra Jhampa of SocGen alongside Jonathan Pingle of UBS. So we have team no cuts in 24 alongside team December now, because we had a changeover at UBS just yesterday. I want to come to SocGen first. Subhadra, let's talk about this data. What does this data tell you? And put it together with what you heard from the Federal Reserve Chairman yesterday and sort of square that circle for us.
This is, of course, one data point.
the fact that the claims number went up is something to keep an eye on, because typically when you tend to see a deterioration in the employment picture, you tend to see that led by initial jobless claims. It tends to be a leading indicator. But that said, again, one data point doesn't make a trend. We'll be looking to see what happens. What was interesting to me in yesterday's summary of economic projections is the fact that the Fed kept core PCE at 2.8% for this year. So they're expecting about roughly 0.2 increases month over month for the remainder of the year in core PCE. So in that sort of context where inflation is still relatively sticky and the job market is quite strong and growth is in the context of 2 to 2.5%, I don't see any need for the Fed to rush in to cut rates.
I want to couple your inflation outlook with their outlook for unemployment. They see it staying exactly where it is right now, at 4%, year-end 2024. Jonathan, how are you thinking about the incoming information stacked up against what they're projecting for the rest of this year?
Well, that was actually a big reason we went from Team September to Team December. I mean, we were actually forecasting an increase in initial jobless claims today to 235. We were expecting an increase in continuing claims, and we were expecting a downside surprise on PPI, and we were actually one of the few shops expecting a 0.2 on core CPI yesterday. We have been watching the data slow and think there's a slowdown underway, but we got an FOMC that really just seems to think growth's fine, and not just fine, but great. I mean, they didn't even mark down their assessments of the pace of the expansion in the first paragraph of their statement, which is typically where an FOMC would acknowledge some moderation. But they seem extremely comfortable with the current stance of policy. They feel like, you know, the labor market is still healthy. I mean, I will agree that is one place where if it does roll over rather quickly, they might respond. But it really looked to us like an FOMC that seems very comfortable waiting and without a lot of urgency to start dialing back restrictiveness.
Subhadra is sitting here thinking, all right, everybody just keep coming to my way, because I've been saying that for quite a while, or no cuts at all this year. Are we asking the wrong question? Are we basically asking when are they going to start the rate cutting cycle and not what the rate cutting cycle is going to look like if they wait longer? In other words, if they do not cut this year, Subhadra, are they going to have to cut much more deeply next year in the face of that weakness that Jonathan was talking about and a lot of people are projecting?
I think I would prefer that than being in the situation that the ECB is in, where they've said they cut rates, and then now it's uncertain if they're going to cut in July. It doesn't look likely that they'll cut they might cut in September, but then after that, they're looking at unit labor costs going up. They're looking at other factors that's going to keep them on hold. I don't see the need for the Fed to cut. I don't see the need for any sort of insurance cuts. Why should they cut and then wait for 6 months to deliver the next cut? Why not just wait for the data to corroborate a need for cuts and then go on some sort of a methodical fashion, or maybe once a meeting or once a quarter when, to ease policy? I just don't see kind of the rush for that first rate cut.
Jonathan, would you agree with that? Are you sympathetic to the view that some have espoused, including Neil Dutta over at RenMac, talking about how this is a rapidly weakening economy, and if the Fed doesn't get ahead of it, that the declines are going to be harder to counter in the future?
I mean, if I were a monetary policymaker, I would probably thinking about some calibration might be needed to ward off worst-case outcomes. I think one of the problems is that we're seeing slowing in growth, but we're not really seeing such severe slowing that monetary policymakers seem like they really need to act urgently. But, you know, we have that. That's our expectation, is that growth is going to slow. It's going to take the FOMC time to digest. But next year, they're probably going to want to pick up the pace a little bit, right? I mean, so we have them after they see payroll slow, after they see GDP growth slow, we've got a little bit lower inflation forecast than they do, that they're going to start to feel like, look, maybe policy really is restrictive, something they've been debating a little bit. Maybe we need to get out of this restrictive stance of policy a little bit more quickly than we expect. So we expect them to have the same terminal rate that they have in the SEP, but get there a lot faster next year and into 2026 than their current projections.
John, I don't want this to turn into a therapy session for Wall Street, but I just imagine it must be incredibly frustrating for you to have absolutely nailed the data of the last 24 hours and then been surprised with the way they've responded to it. What are you struggling with right now? Their reaction function, or just the way they're seeing the data that you've been forecasting? What is it?
I've been a little surprised at their sort of lack of acknowledgement over the degree of cooling, I think, that's underway. I mean, you know, non-farm payroll employment looks good, is certainly a headline, and they've sort of walked away with that as sort of a summary statistic for the strength. But even if we look at non-farm payroll employment, I mean, private employment over the last 12 months has slowed to sort of 178.
Can I jump in? You say they walk away with that. And I walked away from the news conference yesterday and I heard Chairman Powell say something like maybe 272 overstates the strength of the labour market. I just wonder who they is on the committee right now. I find it really confusing. 272 for some seems like it's the real deal, hence the dot plot. It's another part of the dot plot that feels like they're in Camp Powell. Maybe it overstates strength. When you say things like they, who are we even talking about in the committee anymore?
I would actually, in terms of this narrative, I'd lump in the vast majority of participants. I think when I hear Governor Waller talk about the strength, you know, think about Philip Jefferson's speech before the quiet period, talking about, you know, the strength in private domestic final purchases. I mean, they're all pulling out relatively strong components and cuts of the data at the moment. And I feel like you got an element of that in Chair Powell. Even though he might acknowledge that the 272 was overstating, he's not acting as though it's 190.
Mike, what was your take?
I think that at this point, they don't know what they're doing. And so they're going to be honest about that. The difference between Subhadra and John is that you guys have a forecast, and you make a forecast, and they have 19 forecasts. And we, for our convenience, pick out a median and say that's their forecast. It's not their forecast. There's 19 different forecasts, and the range is pretty wide, and especially if you look at 2025. The range is very wide. There's a plurality in the middle, but they don't know what's going to be happening by then. So, and another quarter from now, in September, they'll change their forecasts and their dot plot again, and we'll all recalibrate. I think basically they're in a sort of hold mode, risk management mode, I guess, at this point. We'll see where inflation goes, and we can move, but we don't have to.
You know, John, you didn't want a therapy session. I think that actually
We're
right
about
now,
to get one.
a lot of people are looking for a therapy session because there was a lot of uncertainty, and it's been a very challenging year. So, Subhadra, I'm curious how you come up with a projection of there is enough strength. We don't need those sort of cuts to sort of be cosmetic or get ahead of that weakness. What gives you conviction in that? What's your guiding compass at a time of such great uncertainty?
You can listen to the Fed. For instance, when you listen to John Williams from the New York Fed president, what he said was his expectation is for growth in the context of 2 to 2.5%. He's expecting the unemployment rate to be around 4%. And he's expecting core PCE above or at or above 2.5%. So even from what they're saying, just from their own forecast and the summary of economic projections, leave alone our forecasts and our expectations, there's no clear indication that they're going to need to rush into cuts. That's why I think that, you know, in addition to our own forecast from our economists, what we're hearing from the Fed is also consistent with the Fed that needs to be on hold for the remainder of the year.
Honestly, I gotta say, John, one thing that people, Jonathan Pingle, one thing that people keep saying is all of this out there, it sounds bad, it's hard to gauge, whatever, but you know, NVIDIA is gonna change the world. We're gonna have all these technological advancements. We're gonna have fiscal impulses that come down the pike. How do you factor in sort of the nebulous concepts that have driven this market this year, as opposed to sort of overarching macro top-down views?
So we could get an NVIDIA boost. I would say if that really was a productivity boost, we would see lower inflation, and the Fed should probably have lower rates as well. And the fiscal policy obviously has been huge. I mean, it's really done a lot to insulate the economy from the rate hikes and the rapid rate hiking cycle of Fed. And that is an impulse that's fading right now, and we're going to head into 2025 with a year Congress is probably going to spend having to rewrite a substantial amount of the tax code to avoid the fiscal drag at the end of the year. So these are all meaningful influences. I mean, we all just have to sort of do our best, look at the details, aggregate up. But I mean, I would sort of echo this point. It's not necessarily that you know, we can debate how we're thinking about our growth forecast, but if we take the wide swath of FOMC participants, they just don't seem to be internalizing any trade-off between growth and the level of interest rates right now. And that just seems to be a group that is willing to wait. And the other reason we pushed out our call is just, you know, when they get into September, if they're still not facing a trade-off with weaker growth, you know, I think the arguments will carry the day to wait longer.
I have to wonder, Subhadra, August 22nd, August 23rd, I think it's August 23rd that Jay Powell is going to be in the Tetons, and he's going to be talking to people, giving a message. At one point, it was a very clear message: pain. It's all going to be pain. We need to get this under control. What's it going to be this year?
I think it's staying the course. I think it's caution. For the most part, the Fed is going to strike a cautious tone. In my view, at least, I felt like they pivoted too soon towards rate cuts late last year, and I think that they're going to take a much more cautious tone and wait for the data to guide them on policy. So our expectation is that they'll start cutting sometime in the first quarter of next year, and then deliver a steady set of cuts for the remainder of the year. But then the terminal Fed funds rate is probably going to be higher. We think that the R-star is also higher, and you're seeing that in the market pricing for both the Fed as well as for the 10-year yield, which is higher for longer. So the market is ever so slowly calibrating to a much higher R-star. And so I think that the Fed is going to be somewhat cautious. This feels like a little bit of a paradigm shift, if you will, from the period after the great financial crisis, when we were bringing down the R-star ever so gradually. Now we're going to go the other way and start recalibrating R-star higher.
Just perfectly said. It feels like post-GFC in reverse at the moment, that's for sure. A special thanks to Team 2025 and Team December, Subhadra Japa and Jonathan Pingle. Thank you. Just want to summarize some of the data we got about 15 minutes ago. Mike McKee, what's your take on things? PPI, jobless claims.
PPI also surprises the same way that CPI did yesterday, comes in much lower, although it's mostly goods, and within that category, it's mostly energy. So there are a lot of declines in prices at the factory gate, but it is the big surprise came from how bad energy fell. Jobless claims, a surprise because they haven't been going up. Now they did. We'll see if this is more of a one-off, but if it starts a trend or we get into a new trend level, then the Fed has something to talk about.
We've had a few more head fakes on that particular print, jobless claims, over the last few months. So we'll see if this one is a head fake or not. This from Renaissance Macro just moments ago. The growth and inflation trade-offs for the Fed are shifting. It's getting close to time to recalibrate policy. I imagine we'll hear that a few times a little bit later today.
Neil, I hear you pounding the table. I hear it loud.
Yeah,
I get it. You're like, let's go, let's go, let's go. It's interesting, you know, I'm curious why people are not on that page. And why he is on that page, considering that it's sort of unclear at this point.
I didn't hear Neil Dutta in that news conference yesterday.
No.
At all, that's for sure. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Tesla will likely raise prices for its flagship model, the Model 3, in European markets. That follows the announcement that the EU could impose tariffs on imports of EVs from China, even from Western automakers. Tesla manufacturing does have a large presence in China. The automaker delivered over 900,000 vehicles from its Shanghai factory last year. Tesla said the price increases will likely go into effect on July 1st, and the tariffs would go into effect just a few days later. Donald Trump is back in Washington, D.C. today. The former president is meeting with some leaders of the country's biggest companies, including Jamie Dimon, Jane Fraser, and Tim Cook, according to people familiar with the event. During his one-day return to the Capitol, Trump is also set to meet with congressional Republicans. And Florida is in a state of emergency. Heavy downpours flooded Miami streets and grounded hundreds of flights at the Fort Lauderdale International Airport yesterday. The state has already seen a record amount of rain for the month of June, and more is expected today. Officials projecting that damages will top $1 billion before the rain stops. That's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the program, setting you up for the day ahead and going into the weekend. We'll catch up with Anne-Marie from a beautiful Italy. From New York, this is Bloomberg.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be
be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power.
This is Bloomberg.
Counting it down to the opening bell, about 14 minutes away. The S&P 500 positive by 0.2%. Equity futures with a bit of a lift. Bond market rally, again, we're down by 5 basis points, 4.2655 on a US 10-year. PPI coming in a little bit softer than expected. That's the right kind of downside surprise. This is the wrong kind of upside surprise on jobless claims. Claims come in at 242. The estimate was 225. We've had some head fakes in the past with this read over the last 6 months or so. Let's see if this is another one, but that would be concerning if it continues. 242 on jobless claims. Here's your trading diary for today and tomorrow. President Biden meeting with Ukrainian President Zelensky at the G7. Former President Donald Trump in Washington meeting with lawmakers and CEOs. Treasury Secretary Janet Yellen speaking with Fed President John Williams at the Economic Club of New York. Tomorrow, UMich consumer sentiment survey data and a BOJ rate decision to wrap up a busy week and get you to the weekend. Joining us now before that weekend is AMH at the G7 meeting in the south of Italy. Anne-Marie, set us up for the next 12 hours or so. What are you expecting to hear?
Well, what's really important is going to be Biden's press conference alongside Volodymyr Zelensky. President Biden is really going to want to tout the fact that the Biden administration was able to get over the finish line, really what has been their brainchild for the past few months. And this was the idea of tapping into the future appreciation, that net interest that these foreign and frozen and mobilized Russian assets can potentially accrue. So this is a big win for the Biden administration. He's also going to sign up with Zelensky a bilateral security pact. Of course, we also want to keep an ear out for what potentially Larry Fink and Satya Nadella may say. These are two executives that are coming here to Puglia at a side event co-hosted by Biden and the Italian Prime Minister Giorgia Meloni. They're not going to mention China by name. I highly doubt it. But this is about critical infrastructure in lower and middle income countries. And I think really what this is going to be about is basically saying sign up for what the West wants to do, not potentially what China wants to do. And then, John, a little bit more lighthearted. Potentially the fanfare, though, won't be light. I'm interested to see, although Biden is skipping tonight's dinner with G7 leaders, I'm interested to see what Meloni decides to put on the menu, but he will be at tomorrow's G7 leaders dinner.
Talking about Giorgia Meloni and how she's really leading this, how much has the tone changed from prior G7s, just simply because she is representing a sort of different swing in the voter base based on where the existing politicians, where they have been representing?
I think a question coming into this after the European parliamentary elections and after the polling we've seen in countries like the United Kingdom that's going to have an election in 3 weeks, and the polling we've seen in France and in Germany, and the fact that AfD lawmakers literally did not show up to President Zelensky's address to the Bundestag. What you can potentially ask going into this is Europe moving to the right towards Meloni, or is Meloni moving towards them? And I think what you see is that Europe is definitely moving more towards Meloni. As John said earlier this week, this G7 is Maloney's G7 in so many ways, because you have a number of leaders coming here as lame ducks that do not have the backing at the moment of their electorate, and potentially, in as soon as 3 weeks, may be out of a job.
There's a great headline on Politico today. 6 lame ducks and Georgia Maloney meet the G7 class of 2024. Rings true. Anne-Marie, let's have some fun. Let's talk about the menu. I was at a Macron event a couple of months ago, and there was no food. There was no food at all. There was just black coffee. Can you tell us what you think is going to be on the menu later? And can you tell us how they're feeding the journalists?
At any caliber is what they're going to feed the leaders, and the menu is going to be absolutely spectacular. Even for the journalists, someone like me, as I would say, sono celiaca, I have celiac, I don't eat gluten. They had 2 tables set up with pasta, cookies, cornettos, the croissants in Italian, that are gluten-free. So the food has been unbelievable. I'm interested also in the wine list. I don't know, John, do you think they're going to go Negro Amaro? Are they going to go Susu Maniello, Primitivo? We'll have to see. But I will say this, the Italians are definitely showing up on the hospitality front better than any G7 I have attended.
If you're confused, this is not Bloomberg TV. This is the tourism board for the south of Italy. AMH from the G7. Anne-Marie, thank you. We're not jealous at all.
You know, I'm on strike for the rest of the show. That's it. Until you send me there, I'm not speaking.
Such an Italian thing to do. Isn't it amazing?
I know, it's ridiculous.
Just like, you know, lay it all out.
And it's, of course, you know, softball basically pitched for southern Italy,
for
basically
the fatherland.
Imagining where you could be and how it could be, and just drawing the contrast with France, really. You're going to get hate mail from the French. Oh, yeah, striking. There was no food with Emmanuel Macron.
Just black coffee. They can sort it out next time.
Paris.
They'll learn from that.
Yeah, exactly.
You know, foreign journalists come in. What do they walk away with? They remember what they were fed.
Didn't Alitalia used to have the most amazing food?
They still do. Aerita now. Fantastic menu.
Didn't they go bankrupt?
They did, and that's why. Probably. I'm not saying that's why.
Fantastic.
We need to talk about this market. CPI, softer than expected. PPI, downside surprise. Jobless claims in the wrong direction. Square that with what we heard in that news conference and what we saw in those forecasts from this Federal Reserve.
Andrew Hollenhorst does it by saying, follow the data, not the dots. I really like that idea. Of course, he is still calling for a significant weakening and a significant rate-cutting cycle to begin this year. How you interpret the data, up to you, have fun. But the dots not giving that guidance.
We'll follow that data, and we keep following that data. We'll follow that data into tomorrow. Coming up tomorrow, Jeff Yu of BNY Mellon will catch up with Pooja Sriram of Barclays, Morgan Stanley's Michael Zezas, and PG&E CEO Patty Pope. Looking forward to all of that. Your equity market is positive by 0.3% on the S&P. Your opening bell is about 35 minutes away, and the bond market rally, Bramo, it continues. Yields down 5 basis points.
Shot, chaser, and then another shot with the PPI coming in softer than expected. In the labor market, are we seeing a real softening?
Just need you, Mitch, to come in, going into the weekend, and then the trip's complete.
Oh, is that it? Is that the
Mitch is super important.
It is super important. Forward year.
You take that phone call and tell them how you feel.
Oh, I will. I'll answer online.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
October of 2019, you surprised the business world by stepping down as the CEO of SAP, a very, very large company whose value had more than doubled during your co-CEO position and CEO position. And you took a position with a much smaller, less-known company, ServiceNow. Usually people, when they leave a job, they go to a bigger company. Why did you go to a smaller company?
Well, I saw the future and where it was going. First of all, I want to say I had a great run at SAP, and it was a pleasure taking them from 39 billion to 163 and really inspiring lots of people and customers, and it was a wonderful experience. But after 17 years, nearly 10 as CEO, I was ready to do something different. And when I saw ServiceNow in the marketplace, I knew what it was, and I knew what it could do. And I knew with my background, I was a pretty good cultural fit for what ServiceNow needed to scale it.
So let me ask you, what does ServiceNow really do? Tell me in simple English language that everybody can understand. What do they actually do?
40% of the CEOs say today, if I don't digitize my operations, my company will no longer be viable in less than a decade. So we We're the IT backbone for companies all over the world. How do they manage their assets, run their operations, secure their operations? All things digital having to do with IT.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're
in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg.
From New York City for our viewers worldwide, I'm Matt Miller. Futures rocket higher after another better-than-expected inflation print. The countdown to the open starts right now. Coming up, the latest Fed inflation print, the latest inflation print, nothing to do really with the Fed in terms of the data, that's BLS. Coming in lower than expected, sending futures rising and yields falling. And as the Fed signals just one rate cut this year. We begin with the big issue, mounting evidence of disinflation.
We're expecting a downside surprise on PPI, and we were actually one of the few shops expecting a 0.2 on core CPI yesterday. We have been watching the data slow and think there's a slowdown underway, but we got an FOMC that really just seems to think growth's fine, and not just fine, but great. It really looked to us like an FOMC that seems very comfortable waiting and without a lot of urgency to start dialing back restrictiveness.
Joining us now to discuss is Liz Young-Thomas, SoFi Head of Investment Strategy. Liz, great to have you on the program this morning and on a good news is good news day, right? I mean, inflation slowing down for the PPI after the better than expected print yesterday for the CPI. Markets rocket higher again. How much more room does the S&P have to run?
Well, I won't put a target on the S&P, but I do still think that the market is in a mode of celebrating cooler data, celebrating economic data that comes in a little bit slower, but not too cold. And I think we'll stay in this phase for a little while still because we've been waiting for it. We've been waiting for inflation data to give us some decisive moves downward and frankly, been waiting for at least something to have a negative sign in front of it because what we've been talking about for so long is that, yes, inflation stopped growing as quickly, but it was still rising. So what we needed to see in order to actually take some of the pressure off of consumers was for there to be some month-over-month negative prints. Now, many times that gets misinterpreted as a contraction or something that's terribly wrong, but really when we're looking at the cumulative effect of inflation since it started rising, consumers are dealing with over 20% up in prices in many of those non-negotiable items. So this is still being celebrated by the market, as I think it should be. As the year drags on, the question becomes, when does cooler data become too cool, and what will the Fed do as a response?
Well, in which industry groups is it not great news for? I mean, yesterday we were talking to David Rosenberg. Of course, he's a noted bear, but he says, look in the beige books over the past year, and you'll see that pricing power is declining, right? Corporations are having tougher times raising prices. Where do you see the pain from this?
Well, raising prices, that is true. It is true that it's tougher to pass through the pricing increases that have occurred because everybody knows that the story is inflation has come down, or at least the growth of inflation has come down. So those pricing pass-throughs that benefited companies through much of 2023 because it grew the top line. So it grew revenue because prices were being increased by passing them through to consumers. That has slowed down quite a bit. So now it's a matter of, can companies manage their operating margin with revenues that are no longer benefiting from those pass-throughs? And that's going to go to companies that are well capitalized. It's going to go to companies that have a strong competitive position. And it does make things more competitive in certain industries. As inflation falls in the goods sectors first, it's been more difficult for those companies to pass it through. So companies that are very goods intensive. We've still seen quite a bit of sticky services inflation. Now, I don't think that companies are going to be able to pass that through as easily, but there is still pricing pressure on the upside in some of those services components.
All right, hang on a second, Liz, because I do want to talk more with you about the consumer. I think you have a great perspective on the consumer from SoFi, but right now I want to get in a little deeper to the economic data. More signs of slowing inflation here in the U.S. The producer prices, PPI, decline in May, an actual drop, and we were looking for a rise. Let's get over to Michael McKee, Bloomberg Chief Economics and Policy Correspondent. So, Michael, good news is good news.
Well, good news is good news if you're looking for a rate cut. Jay Powell told us a story yesterday. We needed to see weakening labor market and falling prices before we get a rate cut. Well, guess what we got today? You can see what happened with the PPI headline down 0.2 on the month, and the PPI core came in flat. Jobless claims jumped by 13,000. Question is, will that continue? We're going to have to wait a couple weeks and see if this is a new trend in terms of layoffs. But in terms of prices, what happened? Well, we got a way to show you that. If you have a Bloomberg, go to ECAN Go, and it breaks down what happened. And if you don't have a Bloomberg, call us up and we'll get you one. But you can see there, purple is energy in this chart, and you can see the big move was in energy. Liz mentioned that, down 0.8%. It really pushed PPI down overall. That raises a question of whether it will continue, but what we're seeing in retail gasoline prices when you go up the ladder here is that we are still seeing some declines in prices, which would affect consumers and be good news. Now, overall, the Fed is going to be looking at what's happening with inflation more than jobs at this point, because it's only the jobless claims numbers that changed. And when you look at what's happening with inflation, they want 2 or 3 months. Well, they got at least a month here. We now see that the PPI and CPI went down on a headline basis over the last month. PCE is the one we have to wait for at the end of the month. But now with PPI in, we're going to start seeing some people figure things out. And my initial guess is we're going to see PCE come in rather low as well, if not negative by itself. So the story the Fed wants to see has at least started.
Mike, I had a viewer write in yesterday and say, you know, we're adding jobs to this economy. The World Bank is raising its expectations for growth. Markets are at an all-time high, like 27 new all-time highs this year. Why on earth would the Fed cut rates? Who thinks that these rates are restrictive?
You know, it's funny you should mention that, because I asked Jay Powell that exact same thing yesterday. And basically what he points to is the impact of real rates on the economy. As inflation goes down, real rates go up. And so the Fed doesn't get any looser, and that's hurting things like housing. It makes bank lending much weaker. And so at some point, they think this is not going to be, the 5.5% top is not going to be the level that's appropriate for the economy. They just want to wait and not move it down until they are certain they aren't going to have to move it up again.
All right, Mike, thanks very much. Michael McKee there, Bloomberg Chief Economics and Policy Correspondent, talking to us about the data. Liz Young-Thomas from SoFi, where she is Head of Investment Strategy, is still with us. And Liz, I think at SoFi you have a really unique perspective on the consumer. And that's probably one area where people are wishing for rate cuts, right? It's more expensive to finance a home than it has been in a generation. It's more expensive to finance a car purchase than it has been in a generation. How is the consumer doing now, especially since we see savings rates just have completely dropped to pretty much zero after the pandemic?
Well, I think one of the most important things that Mike talked about was that energy prices have come down. And we know that just the feeling of energy prices coming down and prices being lower at the gas pump does help consumers' sentiment rise. So when you look at surveys like the University of Michigan sentiment survey, that is tilted more towards inflation as a data set. So I would expect there to be some increases in the University of Michigan sentiment survey. So I think overall consumers are hearing this news and feeling good about the future. And that's been something that has been a weight on some of those numbers in the past. And I'm talking about the sentiment numbers. Consumers get asked, how do you feel about the present situation? How do you feel about the future situation? And the future had been sort of a drag because people were worried that inflation would not come down or that it would stay this high and they would continue to have this pressure. So I think these are good signs. What we've seen in a lot of the consumer spending data, and this is consumer spending data at large, yes, they've slowed down in some places. Yes, credit card debt is higher, but consumers still want to spend. They're still optimistic that they can continue to do so because the labor market has remained strong. I can really only say that for this moment in time. I do suspect that as the year goes on, the labor market will cool further. And I think it's going to be difficult for the market to get used to something like an unemployment rate above 4%. We only just had our first 4% unemployment reading, and that was after 28 straight months of unemployment below 4%. So I think there's going to be a little bit of a digestion process there. I would expect consumers to pull back a little bit further, but not yet freak out about the data being a bit cooler.
How does the labor market look, especially for your clients? I mean, you know, Gen Z, they're still very young, but they haven't been getting promotions. I think in the last year, it was only 2.1% of respondents to a survey said they'd gotten promotions, and it had been higher, like 2.5%. This year, we've seen the least promotions for the entire workforce in at least 5 years. So even though, you know, people got jobs, they're not quitting and they're not getting raises, or at least the salaried workers aren't getting promotions.
Well, the quitting part of the equation is really just getting back into balance with where we were pre-pandemic. And we know that we had this very, very tight labor market after the pandemic where there weren't nearly enough workers to fill the jobs that were open. And now a lot of those balances are coming back into a more comfortable place, which Jerome Powell has referenced a few times in his press conferences. So we want to see the labor market get back into a better balance that way. If it weren't, and if employees still had quite a bit of that power, we'd see wage pressures rising, and that's when we used to talk so much about the wage price spiral. So those risks have also come down. I would view that as a positive. The voluntary quits rate is a good indication of how people are feeling about whether or not they would get a different job that was better or higher paying. And it seems lately like people are staying in their spots for longer. Again, this is not a concerning thing, perhaps frustrating for people that had expected the labor market to stay in the ways that it was before, but this is not necessarily something that's sending a signal that the economy is in trouble. Unemployment sends a signal that the economy is in trouble. Jobless claims send that signal. That's not what we're seeing right now.
What about debt loads, Liz? I mean, you know, people come to SoFi to consolidate debt. Student debt is a problem that people have been talking about for a long time. Now we see, there was a great story in the Bloomberg yesterday, some companies are helping employees to reduce their student debt along with matching 401k contributions. But you've also got buy now, pay later, which is hard to measure. I mean, how does consumer debt look to you?
Well, if you look at all of the data that's out there about credit card debt, auto loans, and delinquency rates, we have seen an increase in delinquency rates, and it's been pretty steady over the last few quarters, both in auto loans and in personal loans and in credit cards, and that's for the U.S. at large. That's not specific to SoFi, but there has been an uptick. Now, it's easy to look at that data and see the uptick and be concerned with it. And I do think that it's something we need to watch. I do think it's an indication that consumers, particularly on the lower income side of things, are feeling a pinch. But if you look at it over a long period of time and compare it to previous crises, especially financial crises, it's not at a concerning level at this point. But it is something that we do need to watch, and it is something that is increasing the delinquencies in consumer lending.
All right, Liz, thanks very much. Liz Young-Thomas there, SoFi head of investment strategy, talking to us about the economy, the Fed, and the consumer. Joining us now with a look at the stocks, individual stocks moving ahead of the opening bell is Abigail Doolittle. Abby?
Matt, we're getting pretty used to the S&P 500 and the NASDAQ making new all-time highs, but what we're not used to is Tesla being a part of it. But today that is the case, at least in the pre-market. The stock up nearly 7% as CEO Elon Musk on X said that shareholders had approved his, in theory, $56 billion pay package. Now, this doesn't really carry a lot of legal ramification, but it's more symbolic trust and faith in the CEO and the fact that he will be staying at Tesla. So again, those shares up sharply. Broadcom, this stock is soaring up more than 13%. They beat. There's a positive forecast. But very importantly, the growth coming from AI really offsetting weakness for some other chips. Investors liking that a lot. And then finally, Roaring Kitty back in the news. GameStop, after plunging 17% yesterday, up 3% in the pre-market today. The calls that he is supposedly involved in that expire next Friday, well, there was tons of trading late in the day, bigger pockets of trading. Those calls were worth $6 or thereabouts at one point, $13. Lots of volatility. We still don't know whether he actually owns them and whether he plans to turn them into stock or if he's part of that trading yesterday, Matt.
All right, interesting, as always, to follow the GameStop story, and also Tesla is a huge one, Abigail, that we're going to continue to talk about. Those shares jumped this morning, as she just showed you, ahead of the shareholder meeting.
The biggest AI project on Earth is autonomous driving. And of course, Tesla is in the pole position for that.
We'll speak with an analyst who's bullish on the stock of a company that may pay its CEO a package worth $56 billion. Pierre Ferragu of New Street Research joins us next. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Tesla's annual shareholder meeting kicks off this afternoon. Shares are surging after the CEO, Elon Musk, said shareholders voted, quote, by wide margins, end quote, in favor of reapproving his compensation package, which could be worth as much as $56 billion, and moving the company's legal home to Texas. Joining us now is Pierre Ferragut, New Street Research Global Team Head of Technology Infrastructure. He has a buy rating on Tesla and a price target of $245. Pierre, great to get your take on this. First of all, the plan. I don't know the details. You do, that's why we have you on. But if a company is going to pay its CEO a package that could be worth $56 billion, I don't know that I'd want to be invested in that company. It seems like a lot of money.
Yeah, it's a very strange way to think about whether you want to invest in a company or not. Like the $56 billion taking out of any other complex sounds very odd. Think about it a different way. If I promise you for like multiplying by 10 your money, then I'll get paid 10% of the value of the company. And if I don't reach that goal, I'm not going to get paid. Do you feel that my compensation package is well aligned with your interest? And that's the way you should think about this compensation package that was signed in 2018, in which Elon was promised to get vested, the ability to buy shares in the company at the valuation of the time over the years for a total amount that would amount to 10% of the total value of the company over a long period of time. And so that was a very, very well aligned package in terms of aligning the interest of the CEO with the interest of shareholders without any possible doubt.
I totally get that, Pierre, but here's the thing. Just on principle, fair is fair, right? If you voted back then to give him the prize, if he achieved the targets, now he's achieved them, so he should get the prize. I get that. But now looking back, it just seems like way too much money to pay someone, and you have a chance not to do that. Plus, you could get rid of a CEO who's busy doing way too many other things, a lot of people would say, and not necessarily great for the brand. It seems like a double whammy. Why wouldn't you vote for that?
Yeah, you're creating a situation that is a bit odd, because you're telling me about a company in which you're invested, but you're telling me you don't like the CEO and you don't like the influence of the CEO on the company. So what are you doing here? You shouldn't be investing
change, right? I mean, there was
anyway.
a time when he was focused solely on Tesla. Now he's got his focus also on Twitter. He's also focused on SpaceX. He's also focused on Neuralink. He's also focused on the Boring Company. Plus, he's also focused on all of the social and cultural arguments that he seems to get in all day, like how can you spend that much time on Twitter and still get stuff done? This guy has a lot of other stuff to do.
Yes, and he has been doing a lot of other stuff for the last 10 years, so I still don't understand why you would be in this company. You're creating a situation that doesn't exist. Someone who doesn't like Elon Musk, someone who thinks he's too busy. He has been as busy as he is today for the last 15 years, even the last 20 years, so nothing is changing. So you're creating a situation that doesn't make sense. People who are invested in Tesla today, they believe in the mission of Tesla, they believe in the value of having Elon Musk on board, and they voted very rationally in favor of that. And that explains very clearly a very simple fact you see today, which is that shareholders have voted in favor of the package. And that's the reality. So of course, yes, people who don't like Elon Musk probably would have not voted for that package. People who think he's too busy, people who think he's damaging the brand, all these people would have not voted for the package. But as a matter of fact, they don't have any voting right because they are not shareholders of Tesla.
What about his damage to the brand? I mean, there was a time when he wasn't so outspoken on sensitive issues, and he clearly did the world a favor in bringing electric cars to the market. He achieved something that at the time no one thought was possible, but now I hear more and more consumers say, you know what, I don't want to be associated with Elon Musk, so I'm not going to buy that car. And it does look like they actually have a demand problem in terms of selling their vehicles.
Well, I'd be curious to see where you've heard these consumers telling you that, and if you can put me in touch with them, I'd be interested to see that. publicity is publicity. And, you know, when you're talking about bad publicity, you can also look at, you know, the bottle being half full and not half empty. Elon Musk has like hundreds of millions of followers, is making headlines absolutely every day. And Tesla, as a matter of fact, almost doesn't spend any money on marketing. So just that is gigantic value. Bad publicity is still publicity and is still very, very valuable. And then take a step back. You seem to be very evaluating the situation in a very emotional and subjective way, which is that you think everybody thinks that way, or that like the net effect of the personality of Elon Musk is a negative. But he seems to be a pretty popular guy. And what about all these people who buy a Tesla and are Elon Musk fans? You seem to miss them in your equation. So for one person who is getting upset by like a very polarizing personality, maybe you have another person that is actually very enthusiastic about it. So yes, there is a demand issue for Tesla. You pointed it out. That's right. That's really like the #1 controversy on the stock today. I wouldn't associate that to this idea that Elon Musk would be damaging the brand. I think it's a shortcut that doesn't really make sense from like an analytical standpoint.
Right.
The situation that we have today is that Tesla cars were selling so well that at some point, Tesla management, the market, a lot of observers, including me, thought that market could keep growing and more and more people could buy these cars.
Okay.
What we've realized in the last 12 months is that these people are actually not that many, and we need cheaper Teslas for Tesla to keep growing.
Okay. Hey, Pierre, listen, I'm just trying to take a contrarian view with the bullish analysts. I appreciate your time. Pierre Farragut of New Street Research. Coming up, we're going to give you the morning calls, and then later we'll speak to Adam Hetz of Janus Henderson, who's seeing opportunity in U.S. small caps and mid caps. This is Bloomberg.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Time now for our morning calls. First up, Goldman Sachs initiating coverage of the restaurant sector with a selectively constructive view. The firm is establishing 6 buy ratings, including Starbucks. Wolfe Research raising 3M to outperform, saying the new CEO, Bill Brown, has the right stuff to provide confidence in the medium term. And finally, Bank America upgrading Kimberly-Clark to a buy, citing long-term improvement taking hold. Coming up, we'll speak to Adam Hetz of Janus Henderson.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg.
This is the countdown to the open. I'm Matt Miller. Moments away from the start of trading, we do see futures higher across the board. Tesla is one of those companies that could drive today's trade, as Elon Musk says shareholders are going to approve his pay package. You can see here the closing bell being rung and hear it as well. Let's take a look at the start of trading at a couple of the other assets that we follow. The euro right now at 108. Just about even. The U.S. 10-year yield at 426, 427 after dropping yesterday. It continues to fall another 5 basis points today, and NYMEX crude up about 15 cents to $78.66. As I said, Tesla, one of the stocks that we're tracking at the open, those shares jumping after Elon Musk said shareholders voted by a wide margin in favor of reapproving his pay package. Bloomberg's Global Autos editor, Craig Trudell, joins us now. So, Craig, what do we know about the shareholder vote? They did already vote to approve his pay package once, as the last analyst I had on told me. Now they have a do-over, and they still think he deserves that much money.
Yeah, hoping that twice is the charm essentially here, but this is far from a done deal. We know that this was really more of sort of symbolic significance or you know, a case of avoiding what would have been a catastrophe, in the sense that, you know, had Tesla gone from, you know, getting approval for this back in 2018 and tried to go back to shareholders to get them to give the okay over again, had they not gotten the thumbs up, it really would have hurt their case with, you know, trying to fight this in the courts. And that's really where this is headed next. This is not a case of, you know, after today's shareholder meeting, Musk, you know, leaves with a bag full of stock options. It's very much still going to be dependent on the legal system.
Craig, it's still to me fascinating that Vanguard reportedly votes in favor of this. I mean, Jack Bogle would be rolling over in his grave. He's all about saving money, or was.
Yeah, it's interesting, and that was, of course, a report from DealBook that we've not confirmed just yet. But you know, the amount of support for this on the part of, you know, some big institutional investors, I think of Bailey Gifford, you know, Ron Barron. Some of these names are not necessarily huge surprises, but we did also see some opposition to this, both among you know, big institutional investors and even some retail shareholders who in the past have been big Musk fans. And it is interesting, you know, and sort of unprecedented, not just the scale of the compensation here, but also the fact that it's now sort of, you know, up in the air as to whether or not it will ever be paid out. And you know, shareholders being asked to approve it, you know, sort of retroactively after he achieved, you know, the targets that were laid out for him way back in 2018.
Right, and we should remind people also after they approved it already. Craig, thanks very much. Craig Trudell, our global auto czar, talking about Tesla. Let's turn to chips now. Broadcom has its biggest surge in 4 years after results show huge demand for AI products. Abigail Doolittle has more on Broadcom. Abby?
This is really impressive because it is having its best day, as you mentioned, in more than 4 years since March of 2020. So that's the degree of buying power that we're seeing. Investors liking a few things. They beat both top and bottom line estimates for the quarter that was. In terms of sales for the full year, the company is now saying that it will be closer to $51 billion. That's versus the street at $50.6 billion, and that's versus their previous projection of $50 billion. So that's basically $1 billion better, and a lot of it, as you're mentioning, having to do with AI. Now, they don't sell the AI chips that NVIDIA does, but lots of components in there. In addition, they did buy that VMware, and they've really integrated it more recently. Lastly, Matt, they're following in NVIDIA's footsteps, doing a 10-for-1 stock split. Investors really liking that a lot. The street very positive. The stock right now up 13%. And you could say that Broadcom today is leading NVIDIA, not the reverse in some of those other AI chips.
Yeah, well, a share split like that definitely makes it more palatable to retail investors who might be thinking $1,700 is too much for me to pay for one share. Abby, thanks very much for that. Let's get a look now at Dave & Buster's, which missed estimates. Alex Semenova has more. Not enough video game customers?
I guess not, Matt. It was a really rough quarter for Dave & Buster's. CEO Chris Morris said in the earnings statement that complex economic conditions continued to weigh on consumer demand. Earnings per share came in well below Wall Street estimates. Revenue fell 1.5% from a year ago, and same-store sales declined 5.6% from the same period last year. That was worse than the decline Wall Street analysts had expected. The company didn't quantify guidance, but they did say that sales and profit did improve during the quarter. The current quarter, as they improved some of their stores and built out their loyalty program, though they did say that these macro headwinds continue to be a problem. Restaurants, of course, have been grappling with the dilemma of having to raise costs to cover higher food and wage costs, while also not turning away inflation-wary consumers. Truist analysts expect Dave & Buster's sales initiatives to offset some of these macro headwinds by the fourth quarter. Jefferies said that Wall Street estimates for the quarter were overly optimistic. The stock is down about 10% right now, the worst since September 2022. Matt.
Have you ever been to a Dave & Buster's, Alex?
I think I may have been like once in my life, certainly not anytime recently.
Well, I'm going to go and check it out again. Definitely haven't been there in 10 years. Alex Semenova on Dave & Buster's, thanks very much. Shares of Virgin Galactic are falling after the board of directors agreed to a 1-for-20 reverse stock split. That's because they're worth almost nothing now. Katie Greifeld is here with more on this penny stock. Katie?
Yeah, we are talking about a literal penny stock here, really trying to hold on to its listing on the New York Stock Exchange. Of course, it's trading for about 79 cents a share right now. And when it comes to staying listed on the NYSE, typically stocks have to maintain a minimum average closing price of at least $1 a share for 30 days. So the stock fell below $1 a share for the first time in April. At that point, basically the company proposed this reverse stock split, and now the board has approved it. That is 1-for-20, the reverse stock split there. So we'll see, of course, how that transpires. You can see shares down about 8% right now, but this company is obviously dealing with some very fundamental issues. Just to catch you up here, it performed its last space flight of the year a couple days ago. Now it's taking a hiatus from commercial operations. It plans to pause sending tourists to space in order to focus on developing a new class of space planes known as Delta. You take a look at the reaction in shares, down over 65% year to date. This company obviously has its work cut out for it.
All right, very interesting stuff. I just saw a red headline earlier that Lufthansa is going to invest more money than the entire value of Virgin Galactic in an Italian airline. It's worth in total less than $325 million. So, but we'll continue to keep an eye on Virgin Galactic. Katie Greifeld, thanks very much for that. In the next hour, Katie and I are going to be speaking with the CEOs of Snap-on, the American tool maker, and DHL Supply Chain. That's coming up at 10:30 a.m. New York time, a roundtable interview that you don't want to miss. Now, Adam Hetz, global head of multi-asset at Janus Henderson, weighing in on yesterday's big day, writing, under underneath noisy market reactions to nearly every data release, a consistent signal of a resilient and likely improving economy can be heard. He joins us now. Adam, thanks so much for your time. We got yet another sign that inflation is slowing with PPI today. It actually dropped month over month, and we were expecting a gain. Is this really all good news for the economy?
It's a good question, Matt. Thanks for having me on. And maybe the next one of these we can do from Dave & Buster's. Yeah. But I think that's a good start. So the noisy data out there, the supposed good news for the markets, I do think it might be a dangerous game that the markets and investors are doing here is cheering all the bad news for the economy to root for the translation to good market news and good policy news. So it's been really exciting. It's made for this exciting rally, and that's been good, but I do think it's also a neurotic rally. And it does leave me a little bit concerned from here to the rest of the year, thinking about it could be setting us up for potentially a double-digit drawdown at some point between now and the end of the year. But it doesn't mean we can't be up between now and the end of the year. I think that's just as likely. But those double-digit drawdowns are likely any year. On average, we do have a 16% drawdown in the S&P, even in years that don't include recessions. So I think the biggest risk when investors are trying to process all the data out there, the good and the bad and maybe the ugly from time to time, is that if we do have a bit of a reset, given demanding multiples, given demanding earnings projections, that's not necessarily an indictment on the underlying economy. As we wrote, we do see some good, profound, lingering drivers of some economic strength and reacceleration. So we do think investors need to tap into the data there and stay tuned into that, even if there is some near-term volatility in the top-line market levels.
I see that, and I keep going back to the World Bank assessment of the U.S. economy and the global economy, raising their estimates for both this year. On the other hand, we got today initial jobless claims a tick higher than we were looking for at 242,000. That's also higher than the previous week. Continuing claims also ticked higher than they were last year and higher than we were looking for. And then, of course, we got the household survey last month saying that unemployment ticked up to 4% even, and a loss of 400,000 jobs there. Does the labor market worry you at all? Cracks in the labor market?
Maybe we live in interesting times, right? So PPI release, objectively, maybe bad news. You know, it's talking about a slowing economy. Jobless claims up, slowing economy. But then you had NFP last week. Non-farm payrolls were up. Market sort of shrugged that off. That was good news that needed to be shrugged off to continue the market being good. And so when you put all this together, what I think it really means is that there are potentially some cracks coming, but we have such a strong foundation, it can survive a few cracks. I think underneath it all, more profound drivers we're talking about, like you mentioned, global GDP, US GDP, global manufacturing data, real income data, all very strong and staying strong. So I think if you really focus on that, then take a broader portfolio view, even in the face of potentially near-term volatility, like I mentioned, a potential drawdown in the S&P, you can look at that as more of an opportunity to invest more and hopefully broaden out of what are a lot of concentrated portfolios right now.
You know, you run multi-asset at Janus Henderson. Lou Wang at Bloomberg News wrote a great story about the bear market in diversification a couple of days ago. And I keep thinking about this because, you know, we've been trained that diversity is the safe way to invest. On the other hand, you'd be much better off just buying an S&P 500 index tracking fund for the last 10 years. How do you look at this? I mean, right now, all your eggs in one basket seems to be the winning solution.
Yeah, I've thought about this once or twice over the last decade or so, Matt. And sure, for the most part, if you've been diversifying, you've been defending, and it keeps working in that now everybody has these golden handcuffs, in my view, as far as the concentration, Magnificent Seven, even just the top 5, this historic level of concentration in the S&P. So I think that the delicate piece right now is you're thinking about this economic reacceleration, and we're pointing to some of the objective data that are driving that view, but it's still late cycle. We can stay late cycle for a long time, but it does make it an environment for risk-taking, albeit careful risk-taking. So when we're thinking about getting out of just that concentrated S&P exposure, it means going down in cap in the U.S., it means going ex-U.S., so it's not just the other 493 or even 495 in the U.S., it's also getting ex-U.S., but that's delicate. You have to be careful because when you're getting out of the S&P, you're getting out of these large cap growth exposures, which can be more defensive in nature, and you're taking more cyclical risk in a late cycle. So there are some hedges to that in the sense of we're going down in cap, we're going international, but we're staying active, we're leaning towards growth, we're leaning towards quality, and we're seeking out those margins of safety in case there are some speed bumps ahead, even if we stay late cycle for a long time.
By the way, yesterday I was listening to Bloomberg Business Week on Bloomberg Radio, and I heard a bond investor talk about looking at and getting into uranium. When you look at the different asset classes, I mean, stocks and bonds we talk about all the time, but copper's been an incredible story. Uranium's had an unbelievable run. What do you think about, and you know, on the inverse side, you know, grains have had a tough time. What do you think about commodity investing right now?
From a multi-asset perspective, that ties right into the late cycle thesis here, which is probably what brought you to that. That should be good for commodities. We're talking about still a somewhat inflationary environment, this economic strength, this reacceleration, this demand, that does drive, you know, good demand for commodities, and should be a relatively good market for commodities as a broad asset class. I think if you look at the three legs of the stool from an asset allocation perspective, you think about commodities from a capital market assumptions perspective, at least when you look at our long-term capital market assumptions, you're talking about relatively modest returns, relatively high volatility, but typically very low correlation. So going back to the diversification point, that is a valuable source of diversification because it does have that low correlation, and it does tie into the late cycle stage that we're in, which should be helpful for broader commodity prices.
Just to round out with another asset, FX I think has been interesting in that we haven't seen a lot of movement of late for the dollar, but you know, in a strong economy, the Fed shouldn't have to cut rates, especially with stocks at an all-time high. Meanwhile, the ECB just cut, the Bank of Canada just cut. Is there a little bit of a central bank divergence that you think is going to start making waves in FX?
There are a few things to unpack there. So first, as you put it, it's this tug of war with fixed income yields because you've got this strong economy that should be pushing yields up on the 10-year, but then you have the supposed Fed cuts at the end of the year. Although we were rounding to 10 Fed cuts at the beginning of the year, and now we're rounding almost to 0, but still you have that downward pressure on yields. You have this tug of war with traditional fixed income yields in the U.S. The U.S. 10-year right now, of course, treading water around the 4s, kind of mid to low to high 4s. And so if you take that as the premise for U.S. yields, and to your point, you're having this monetary policy divergence from ex-U.S. where you're already seeing cuts and more willingness to cut. So then that is short-term good for the dollar. I think from an asset allocation perspective, zooming out a little bit, that's not necessarily something that I think asset allocators want to trade on right now because it's a very volatile part of the portfolio. When we talk about the fixed income part of a multi-asset portfolio, I think I just leave it as we do stay dollar hedged unequivocally just to limit that currency volatility in the fixed income portion of the portfolio. And then within the equity portfolio, we're broadly unhedged in the equity portion of the portfolio. So maybe to tie that all together with an asset allocation perspective, I don't think that the currency risk is a huge driver right now. But also to your point too, I think that the dollar strength right now, that still should be stable for the foreseeable future.
Adam, great having you on the show. Thanks so much for joining us. We'll meet up at Dave & Buster's after. Adam Hetz there, Global Head of Multi-Asset at Janus Henderson. Coming up, Apple rides the AI wave.
Apple has kind of regained its seat on the throne here, you know, next to the top players. And I think the story there is, you know, pick up in China and then also some talks of the AI integration and things like this. They're finally on the map with that. We just hadn't heard anything compelling from them in a long time about that.
We'll take a look at the company's record-breaking week next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
You saw nothing today that's better than the competition. You saw nothing today that's different from the competition, except marketing and a focus on privacy, right? So that's the difference here. They're not the first, but they're also not the best, and they're not the most advanced. They're here extremely late, and they showed up to the party without a gift.
Apple has been on a wild ride in terms of the stock. Briefly, market cap overtaking Microsoft yesterday. The recent strength coming after the company revealed its long-awaited new AI features earlier this week that didn't really seem to be much at all. Bloomberg's Abigail Doolittle joins us now for more. Abby?
Yeah, this one is a bit puzzling, and it's up again today. Right now, its market cap, at least the last moment I looked, more than Microsoft. It's pretty extraordinary that you think not so long ago this stock was basically in a bear market from its December peak. Yesterday's move higher, I don't think I've ever seen anything like that on a major stock coming out of a range, up 14% over the last 2 days into today at the highs. That was the most since 2008. It really felt silly given the fact that the AI evaluation not so strong. Although to be fair, I've had some people on X reaching out to me saying that their AI is better than some people are giving it credit to. But what I'm really looking at, valuation at this point, well higher than the group, 30% above, 42% above from a PE standpoint at the high end of their range. Plus, Matt, the numbers, single-digit growth. For this year, their top line is expected to grow 1%. That's after dropping 3% last year. Next year, if they get it together, 6.5%. The bottom line is also single digits. So when you put it all together, does that mean that a stock should basically over the course of less than 2 months, or basically 2 months at this point, be up, let's see, I think that it's up, more than 20%. I mean, it's just a massive, massive run in such a short period of time, but especially this week.
Yeah, and I mean, the interesting thing for me about Apple has always been how much cash they have. At times, $200 billion right now. It looks like, more than $100 billion in cash. And yet the dividend is like a quarter a share, right? They do buybacks at some points, but I feel like, yes, we're locked into the ecosystem, those of us who use the iPhone, and this is going to hold us a little tighter to it, but they really need to give back some cash to shareholders to justify not coming out with any new products, canceling the car. I mean, just not really innovating.
Well, right now, I'm not sure that I necessarily agree because the stock is doing pretty well. Investors seem to be fine going in on this massive valuation, even without that justification. Some people, actually, Alon Rosen over at Oppenheimer, he was telling me yesterday that there is talk out there that the upgrade cycle that will be revealed in September is going to be huge. But something I would point out, this stock on this move hitting up to the top of a very reliable range. The technicals here are not very supportive. There is the possibility it could break out of the range as it did do about 2 years ago and then come back in. But the RSI or momentum over the last 5 years, Matt, it is weakening. It's really telling you that as the stock hits these all-time highs, it's on less bullish confidence than it had been a few years ago. Something else I would point out, Berkshire had been selling. The way that it has popped out of this range, it feels like it's either a big player or it's just a simple trading vehicle. In terms of when Apple was going down, you had NVIDIA, Microsoft, all these other tech companies going up. Some are saying that it was being used as a funding short for that, and now those investors, almost like a seesaw, they want to be in their big tech that goes higher. It's Apple, but what goes up must come down. That's sort of how it feels like with Apple here, especially given these fundamentals, and also, yeah, what you're talking about in terms of not really increasing that dividend, at least yet.
All right, Abigail, great to get a look at the technicals with you, as well as more on this story. Apple adding just an immense amount of market cap in its run-up this week. Abigail Doolittle there on the stock. Coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Time now for the Trading Diary. What you need to be watching. Treasury Secretary Janet Yellen will be speaking at the Economic Club of New York at noon Eastern. And then later this afternoon, Tesla will hold its annual shareholder meeting, the big vote on the potentially very big pay package, surely the biggest in history. We'll also get Adobe earnings after the closing bell, so you can continue to watch what tech does in terms of earning money. Overnight, we're going to get a Bank of Japan decision. If you want to follow along on your Bloomberg terminal, type BOJGO. And tomorrow we have the University of Michigan consumer sentiment data. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.
feel like this age of abundance over the last few years of just how much was being made?
For my personal taste, I am thrilled at what I get to find every night if I have time to look for something. So I personally don't think too much was made. I think the customer will tell us when there's too much made and they won't watch things. And I think part of the misalignment I talked about before is imagine if things didn't get picked up or movies didn't get made that people didn't watch or go to see. That's how it used to be. The customer decided. I do think there's going to be less made in the middle price range. I think there's going to be more made in the higher price range because when you get to global events like Barbie or Oppenheimer or Super Mario Brothers, it's worth the investment, and it's clear that the audience is there, and they just need to be given what they want. The middle, which ends up quickly on one of the services in a way that we're watching movies that we don't know how they got made or when they got made and all of that, I think that will probably be curated better, and I hope there's more inexpensive things that give more people the chance to express themselves and have their work seen.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Brokers Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so check us out there. It is Alex Steele, Paul Sweeney here in our studios. Coming up today, we're going to check in with Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, get his thoughts on what we heard from our Federal Reserve yesterday and kind of where we go in terms of interest rates going forward. Plus, Christina Hooper, Chief Global Market Strategist at Invesco. We're going to get her market call. Then Salih Yilmaz, Bloomberg Intelligence Senior Energy Analyst, to discuss recent research surrounding oil prices. So I'll just defer to Alex on that whole discussion. Oil, I don't know what's going on. I filled up my tank yesterday.
Yeah, go ahead.
I filled up my tank yesterday at $3.40. I was pretty happy.
All right. No one knows what's going on.
Okay.
I'll just spoil it for you right there.
All right, so we'll see if we can get something going on. Anyway, we got a lot of smart conversation coming up. The next 2 hours, we lead in heavily on our Bloomberg Intelligence research analysts here at Bloomberg. But right now, let's kick everything off with Lisa Mateo. She is here in our studio.
Good morning. Market Drivers brought to you by IBKR Financial Advisors. Switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest at ibkr.com/RIA. All right, to the markets we go, where stocks are mixed, and this is after some more economic data came in this morning. Initial jobless claims, they came in hotter than expected last week, rising 13,000 to 242,000. That was the highest level in 9 months. California accounting for the most. Continuing claims also rose too. Then we had U.S. producer prices. They unexpectedly fell in May by the most in 7 months. PPI for final demand dropped about 0.2 from a month earlier. Compared with a year ago, it rose 2.2%. So let's get to the numbers. We have the NASDAQ up 0.6%, 116 points at 17,725. We have the Dow down 0.6% at 243 points, 38,467. And the S&P 500 Up about 0.1%, 6 points at 5,427. Let's take a look at the bond market. We have the 2-year yield 4.71%, down 4 basis points. The yield on the 10-year 4.27%, and that's down 4 basis points. Quick check of commodities. We have spot gold lower 2,313 an ounce, Brent crude $82 a barrel, WTI crude $78 a barrel. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. We have some breaking news for you here. The Supreme Court is upholding full access to mifepristone abortion pill. So this ruling came as the FDA had imposed restrictions on the pill that the agency found were unnecessary. And a court considered a Biden administration appeal of that ruling. And the requirements were things like making in-person visits to their doctor in order to obtain this pill. And it looks like the FDA won this case, Supreme Court upholding full access to mifepristone abortion pill. The issue really was about, did the FDA overdo it? Did they expand when they shouldn't have? We are going to be talking about that much more. June Grasso is in studio joining us. No, you're ready? You're good? You're good? Great. Okay, great. Hi. Thanks for joining. You ran here. We appreciate you.
Yes, thank you.
Okay, so walk us through the importance.
Well, obviously the importance is that mifepristone is the abortion drug that is most used, excuse me, in this country. So putting restrictions on it would mean problems for a lot of women in this country. In this case, what the Supreme Court did, and this is not a surprise decision actually, because after the oral arguments in the case, it was pretty much telegraphed by the justices that they were going to go off. They're not talking about mifepristone. They're not talking about abortion. What they're talking about is standing, which is a procedural thing, really. And it's a way sometimes for them to get out of cases, out of deciding the merits of the case by looking at the procedural elements. So here they said that the doctors who challenged it and the groups who challenged it didn't have standing because they weren't hurt in any way. One way they put it is like, have a dog in the fight. So the doctors, they were trying to show that they had some injury. What was their injury? It was very speculative. If someone came into an emergency room and needed an abortion, and it just was ridiculous. So at that point, the justices all seemed to agree that they didn't have standing. So it's an off-ramp. They haven't decided anything really about abortion.
Okay, but this, for all intents, this settles the issue as it relates to this particular drug. Is that the case? Is that where we are right now, I guess?
I'm not sure, because I think we'll see challenges to all kinds of abortion, abortion pills and everything else, because the lobby is so strong against it. So I'm not sure this ends it. This ends this particular challenge, but I don't know that it ends any challenge to mifepristone. They still have the base. They still have the base challenge, which is that the FDA didn't have the authority to put mifepristone on the market the way that it had through the, get it through the mail and things. So, I'm not sure. They may be able to find a different group that has standing and, reassert the challenge. But, I don't know what group they would find.
So if I just sort of break this down in layman's terms, so the Biden administration made this drug more widely available. Then the doctors said, we don't want this. We want more restrictions. Is that what this is? Can you walk us through
one doctor's group, a doctor's group that is anti-abortion, a conservative Christian doctor's group, challenged it. And the way these things work is, there are conservative organizations and conservative legal groups that go out and look for plaintiffs to find when they want to sue on something. So this group in particular sued in this case. Some states tried to intervene and the Supreme Court didn't allow that. So, states may be able to come forward and say this hurts what they say is that this hurts our bottom line because we don't get to have, different healthcare choices. There are all different ways.
Because in the lower court, ordered the FDA to impose restrictions on the pill. that the agency was like, look, this is not necessary. And these are things like you have to make an in-person visit to your doctor before you get the pill. That is what is no longer there, right? Like that is what the Supreme Court ruled and said, nope, you can have this free access.
Right. Now, I haven't read the case. I don't know if they sent this back to the Fifth Circuit or not.
Okay.
So I don't have the case in front of me. I'm sort of working in the dark here. I don't know if they sent it back.
Your dark is better than us, so
Yes,
you're
thanks.
good.
But I don't know if they sent it back to the Fifth Circuit for more findings, because this came up from a Texas judge. And the Texas judge had even more restrictions on it. And it went to the Fifth Circuit, and they dialed back some of the restrictions, and then it went to the Supreme Court. So when I get my hands on the opinion, I may be able to tell you more.
Now, does this affect individuals? How does this affect individual states and women in those states that no longer have access to mifepristone?
So, you know, it should. Individual states can do different things.
Okay.
So individual states are looking for a lot of different ways to penalize women who leave the state for abortions. So, but with mifepristone, because it comes through the mail, it's much easier for women to get. And in fact, some organizations have been stockpiling mifepristone just in case anything happened with the Supreme Court. So, what they'll be able to do, I mean, I think what this says is, for right now, there's full access to mifepristone. I mean, the states have been ingenious in coming up with ways to try to stop abortion. I mean, you've seen the different ways that they've tried, not only, you know, to the point where women can't even get emergency medical care if they need an abortion. And that case is coming up, by the way, that Idaho case is coming up, whether or not, if a woman is not in fear of, her life is not on the line, but perhaps some other things are on the line, perhaps her organs are in jeopardy or something like that, whether they have to give her an abortion if that's what is necessary. And that's coming up. That's an Idaho case that was heard late in the term. So there are ingenious ways to try to stop abortion, and I don't know for sure.
But in reality, can women in all 50 states get this via the mail?
Yeah.
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 So, I mean, there's no, and I'm not sure how is there practical ways you stop that?
Well, there's an act that hasn't been, there's an act that hasn't been, the Comstock Act, that hasn't been used for I don't know how long, and that some conservatives say that may be the next avenue, that you shouldn't send certain things through the mail. So that could be another way to attack it. As I said, I mean, I don't expect this to be the end of the attacks. I just think that it's just been shown that there's so many ingenious ways to, I mean, this is the law. You know, you have,
this is what we do
you
here.
have one argument, and it turns out there are 10 arguments. So, but this one, you know, why it was easy for the Supreme Court, I'll say easy in quotes, because they found an easy way to get out of it. They just said, and they do this a lot.
Right.
You know, people will say standing. What's standing? Standing, I had a professor that once said, you know, the ingeniousness of lawyers is that you can always find a way to turn it into a procedural argument. And that's what they do. And in this case, it was pretty easy because you didn't see any injury to doctors. What injury did they have?
So you mentioned the Idaho case. That's Moyle versus the U.S., right? And at issue, it seems like, does the federal law permit ER doctors to perform abortions to preserve a woman's health, even if states outlawed that procedure? So this is to your point of like, can they save the woman or can they help the woman even if the state outlaws abortion altogether?
So Idaho has a law that allows abortions if the woman's life is in jeopardy. The Biden administration came in and said, no, because you're taking money from the federal government, right? We have the right to tell you that you have to also treat women who come to an emergency room, and it's not that their life is in jeopardy, but something else is in jeopardy. Their organs are in jeopardy. I mean, different kinds of things, right? I'm not a doctor, so thank God. I'm not a doctor, so I don't know what, but different kinds of things. And you have to treat that woman and give her an abortion, even if her life isn't in jeopardy. So that's the issue. And that case, I mean, there was a little more, I couldn't tell you how that case is going to come out because it wasn't as clear. Some of these cases, you know, we say, oh, we don't know what they're going to decide, but it's pretty clear what they're going to decide. I don't know about the Idaho case, how that's going to come down.
So this particular ruling here, it feels, just reading on some of the initial reporting, that it's kind of a technical lawyer type thing.
Yeah, procedural.
In terms of standing.
That's what I said.
So, I mean, it sounds like, as you mentioned earlier, that they can, or various groups can come back and approach this issue from other angles, perhaps?
As I said, it's ingenious, the number of ways. I mean, it's sort of like if you remember affirmative action, and for many, many years, affirmative action, it kept on getting, the protest to it, or the challenges to it kept on getting rejected. And then there was this man who has Students for Fair Admissions, and he kept fighting and fighting and fighting and waited until the Supreme Court turned more conservative, and then all of a sudden the Supreme Court, reversed itself and said, no, we can't have affirmative action. So, I mean, that's what I mean. They have very well-funded groups that are fighting abortion on every level. So I don't, rule out the fact that there'll be other challenges to it.
All right. Hey, June, thank you so much.
Yep.
She literally booked in here. We really appreciate you. Thank you.
She literally ran down the hallway.
No, we saw her. Yeah.
Holding the, thank you very much,
Yeah,
June.
thank you so much, June Grasso, Bloomberg, joining us there. We all want to go to Madeline Meckelberg. She's Bloomberg legal reporter. She also joins us on this news. And remember, let's just recap here for a moment. The Supreme Court has ruled that there will be full access to mifepristone abortion pill. Madeline, can you walk us through how this case unfolded?
Hi, thanks for having me on to talk about this case. So the Supreme Court this morning, they overturned a decision from a federal appeals court that would have prevented mail-order prescriptions for mifepristone. And this is a case that started in Texas. It was a conservative group. They challenged access to the abortion pill and were seeking to have the original FDA approval of the pill rolled back. As the case moved through the courts, the federal appeals court in New Orleans, that's the Fifth Circuit, they basically said they can't go back enough in time and undo the original FDA approval, but what they can do is turn back some of the more recent decisions, which would have allowed the pill to be sent through the mail and used in a wider number of abortions. What the Supreme Court did today was say full access has to be preserved.
So is this the final word for mifepristone and its availability in this country, or is it still perhaps at risk of some regulation?
So I think we're still going to see some action on this. This case was on kind of a preliminary basis at this point. I think we could see it come back up again. And what the Supreme Court did today was not rule on the merits of the FDA's decision to approve mifepristone. They blocked this lawsuit on standing. So they basically said that the individuals that brought the challenge, they didn't actually have the right to sue because they couldn't demonstrate that the FDA's actions harmed them directly, because federal law protects doctors from providing abortions if they have moral objections. So they said these people can't sue, but that does mean that there maybe is a pathway for others to bring a lawsuit if they wanted to challenge the same thing.
When does the Supreme Court term end, and what are some other big ones that our audience for Bloomberg Intelligence Radio will be interested in?
That's a great question. I know that we're waiting for at least one other abortion decision as it relates to emergency room access in Idaho. There are a couple big Trump cases on the docket, so we've got a couple weeks left where we're going to expect to see some decisions, and we'll be keeping an eye out.
Madeline, how unexpected was this ruling given the makeup of the court today?
I think it's definitely, if you're looking just at the makeup, this is a surprising decision given what we know about this court that is the same one that overturned Roe v. Wade. But when there was a hearing on this case in March, we definitely got a sense from justices that they were skeptical about the standing issue that was raised in this lawsuit. So while broadly speaking, this is kind of surprising for this court, based on this case specifically and what we heard from justices previously, it's in line.
We were talking to June about the other abortion case that's coming to the fore as well, Moyle versus the U.S., and that really centers around Idaho's abortion ban, considering whether a federal law that requires hospitals to provide stabilizing emergency care trumps any abortion restrictions. Does this give us any roadmap for that case?
It's hard to say. They're really different questions. I think that what we know is that the court is considering any abortion question that comes before it pretty carefully in light of this Roe decision that sought to return things to the state. These are two examples where we're seeing them having to deal with the consequences of that decision and them weighing in on these regulations. So they're kind of different issues, but I think that we can expect to see maybe some nuanced perspectives from the court on this.
All right, Madeline, thank you so much. We appreciate that. Madeline Meckelberg, legal reporter for Bloomberg News. She's based in Austin, Texas. And it just, when you get a piece of news like this, coming across that maybe is not in our typical remit. We have some experts literally around the corner in June Grass, so literally a phone call away, and Madeline Meckelberg to help us understand what's happening.
Which we very much appreciate.
Which we very much appreciate. Makes it sound a lot smarter.
Yeah. In the markets, though, I have to say, it is boring.
Boring,
I don't know what the actual next catalyst now will be. Like, stocks are pretty much doing a whole lot of nothing. Short yields continue lower, so maybe it's just sort of how low can yields actually go? Is now the time? Are we seeing short covering, or is this real buying on duration? What's really behind all of that? And what do you do? And what are you waiting for? You got to wait till September and December? Like, check you later?
Exactly. So we'll have to see. Coming up, Christina Hooper, Chief Global Market Strategist at Invesco. She's going to help us discuss the outlook for these markets, given what we heard from the Fed yesterday. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks are mixed, and this is after initial jobless claims came in higher than expected last week. And U.S. producer prices, they unexpectedly fell in May. Now, this all aligns with the surprise slowdown in consumer prices and could boost spirits at the Federal Reserve. Now, that said, wholesale gasoline costs accounted for more than half of the decline in goods prices. Diesel, jet fuel, electricity costs also declined last month. So let's get to the reaction in the markets. We have the NASDAQ up 0.3% or 55 points. We have the Dow down 0.5% or 211 points. And we have the S&P 500. That's little changed. All right, let's dig a little bit deeper, too, as we start to get into that. We'll go into the 11 major industry groups. The biggest push coming from information technology. Then we go a little bit deeper under the hood. We see semiconductors. And at the top is Broadcom. Yeah, that comes after its latest results. It topped estimates. Also announced a stock split. Shares of Broadcom right now, they're up about 11%. That was followed by NVIDIA and also Texas Instruments. Let's check in with the bond market. We have the 2-year yield at 4.70%. That's down 4 basis points. The 10-year yield at 4.27%, and that's down 4 basis points as well. And as far as commodities, we have spot gold lower at $2,311 an ounce. Brent crude, $82 a barrel. WTI crude, $78 a barrel. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news and analysis with our Bloomberg analysts. They cover 2,000 companies in 130 industries worldwide. And then sometimes we take you outside Bloomberg Intelligence for the view on the street. Today we go to Christina Hooper, Chief Global Market Strategist over at Invesco. She joins us now. Christina, I got to say I'm bored now. Like, we got through CPI and we got through the Fed. Okay, bonds are still getting a bid. So I put out there that we could see some significant levels now, lower in yields. What do you make of the market? What are we going to be looking at next?
So I think next up on the docket is going to be Friday's inflation expectations from the University of Michigan. Now, it might not seem that important, but to central bankers, consumer inflation expectations are important. It's part of the calculus. If we go back to June of 2022, you may recall the Fed messaged in advance of that meeting that it was only going to hike 50 basis points, then turned around and hiked 75 basis points. And when asked about it at the press conference, Jay Powell pointed to a few different data points, including Michigan inflation expectations. So I think it's important. But I also am confident that it's going to show that inflation expectations are pretty well anchored. And it will be part of the mosaic of data that the Fed reviews next time, and which I think will cause the Fed to begin cutting in the third quarter.
Cutting in the third quarter. Okay. So I know, at this time of year, Christina, every 6 months, you folks at Invesco, you bring together some of your key investment professionals, thought leaders, and think about the next 6 months. What's the next 6 months look to you guys?
So in terms of the economy, we expect to continue to see a slowdown in the U.S., a cooling, but we would anticipate that that's going to be relatively brief and that by the end of the year, we'll see a reacceleration in growth. There'll be catalysts like the start of rate cuts, as well as improvements in real income. That will help consumers. Mm-hmm. So all in all, a better picture economically by the end of the year, but nothing bad in between. And we would anticipate markets starting to discount that soon. So that would mean a broadening of the stock market, more participation, better performance from cyclicals and smaller caps, and in a more sustained way once we start to see the rate cuts begin from the Fed.
Christina, but once you see that growth and the cuts, does that lead to higher inflation then?
No, I think that the Fed has done a very good job putting out the flames of higher inflation. So I don't think the risk is as big as they suggested yesterday, that there could be some kind of resurgence in inflation. And we certainly don't have the kind of fiscal stimulus we had that I think was an important part of why we saw such a big increase in inflation. I just don't see that happening going forward.
How about in Europe, Christina? Last couple of days we've seen some changes in the EU. We've seen in France snap elections. We now have The France-Germany 10-year yield gap set for the widest since 2017.
Look at you.
Look at me going.
BTP Bund spread.
Exactly,
All
all
right.
geopolitical. How do you think about the European zone? Because there seems to be some unsteadiness there.
Well, we try to put blinders on when it comes to politics because it can cause volatility in the short term, but beyond that tends not to have a significant impact on markets. So when I look at Europe, what I see is positive economic surprise, and I see the potential for more of that going forward. We also, when we look at European equities and UK equities, what we see is greater exposure to cyclicals, so they'd be more sensitive and potentially benefit from an economic reacceleration. And I also see an increase in stock buybacks coming in both those markets. So there's a lot to be very positive about when we look at Europe and the UK.
How can you put blinders on when it comes to politics, in that we've seen a lot of violent shocks in the market, whether it's France or Mexico or South Africa or India, and the market reaction is what seems to be catching investors on the back foot. Are we learning a market reaction function to the election in November?
Well, I think there's certainly the possibility that we have a significant market reaction in the short term. We have seen that, absolutely, with Mexico, with India, and there's certainly the potential for it to happen again. But most investors have a longer time horizon than 2 weeks or a month or 2 months. And so that's why I would argue it's important to put blinders on when it comes to things like politics.
All right, so if we want to stay close to home, U.S. equities here, do I just stay with the big cap growth names that have worked so well for so long, or do I try to get a little bit more bold here, take a little more risk, and try to find some value out there?
I think you need to be well diversified, and for most investors, their portfolios are likely overweight the large caps, the growths. So it's time to rebalance and ensure there's adequate exposure to smaller caps, to value, to cyclicals. I think those areas will perform better as we start to discount a reacceleration in the economy. That doesn't mean that the big cap tech names are going to do terribly. It just means that participation is going to broaden, and we could actually see outperformance by the cyclicals.
Is that so diversified? So and I know you mentioned cyclicals over in Europe as well. Is it do you need to sell tech to buy the cyclicals, or do you just need to sort of take from cash? What do you think?
I think what's more likely the case is that there is an overweight to cash in investors' portfolios, and especially as the Fed begins to cut rates and cash isn't paying as much, there's a greater argument for reshuffling and at least allocating some of that overweight to cash to cyclicals. But in some cases, there could be extreme overweights in portfolios to technology and large cap growth, and it also makes sense to rebalance there as well.
How about alternative investments? We have private. We all grew up with private equity, hedge funds. Now there's private credit. It seems like there's a lot of opportunities to allocate capital to alternative investments. How do you guys at Invesco think about that?
We think that makes a lot of sense. We were one of the earliest proponents of including alternatives in portfolios. Still believe that's prudent for many investors' portfolios, that greater diversification, lower correlations, it all makes sense. And there are certainly many opportunities we're seeing in areas like private credit. And I would actually argue there are opportunities appearing in real estate as well.
Ooh, where?
Well, we're certainly seeing European real estate has bottomed. And I also believe there are some opportunities in U.S. real estate that will appear as the year progresses. Keep in mind that one important tailwind, again, will be rate cuts.
So given what we saw, Christina, yesterday from the Federal Reserve, what we heard from the Federal Reserve, what's penciled in is your base case here? I know a lot of folks are trying to get a sense of, do we have something in December? Do we have something maybe even a little bit sooner? But oh boy, we have this election. How do you guys think about it?
Well, we hate to have false precision, but I do think we believe the most likely scenario is 2 rate cuts this year. And obviously the Fed is very data dependent, so that can change. But based on what we've seen in terms of disinflationary progress, And given what the Fed told us yesterday, which is that they anticipate one rate cut without any progress on disinflation. Keep in mind their core PCE target, their forecast for the end of this year is where core PCE is today. So I would argue that means that no progress equals one rate cut. Then some progress in disinflation, which seems increasingly likely, could mean 2 rate cuts. I'm a believer in that. So I would argue the most likely scenario is September, December. I don't think the election is going to change the Fed's timeline. They've been clear about that.
Christina, really, really interesting conversation. I learned a ton. Christina Hooper, Chief Global Market Strategist over at Invesco. And that's the jewel, right? You get growth,
yep.
You get cuts, and you have inflation coming down. And that leads to your cyclical bias at the end of the day.
Seems constructive. Right,
that seems like the best case scenario. Yeah, absolutely.
Like a pretty darn good scenario.
Bank of America also saying that the pain trade in the second half could also be led by cyclicals because kind of no one's investing in them because they're all in tech and overweight tech at the same time. We didn't get to talk about bonds, but we will in the next hour. You're looking at the 10-year down by another 3 basis points. We're at 4.283. That's where we are for the 10-year. Also that 2-year coming down as well to 4.7% as, let's be honest, equity market's not doing much. Michael Barr is here with World and National News. Michael.
Thank you very much, Alex. Paul, Lisa, breaking news. The Supreme Court has ruled to uphold full access to the abortion pill mifepristone. Bloomberg's Amy Morris reports from Washington.
The justices preserved full access to a widely used abortion pill in a case that carries major stakes for reproductive rights and election year politics. The court unanimously overturned a federal appeals ruling that would have barred mail-order prescriptions for mifepristone, the drug now used in more than half of U.S. abortions. The lower court ruling would have reduced abortion access even in states where reproductive rights have broad support. The majority on the court said the anti-abortion doctors and organizations that sued lacked legal standing because they're not directly affected by the FDA's actions. In Washington, Amy Morris, Bloomberg Radio.
The G7 nations have agreed on a loan to provide Ukraine with about $50 billion in new aid by the end of the year. Bloomberg's Oliver Crook has more from the summit in Italy.
The form that this will take is multiple loans done sort of bilaterally between each of the G7 countries. The EU will be its own bloc, and each of these loans will be then given to Ukraine. And this is the key detail here. The question was, how much will everyone contribute? It's going to be proportional to the size of the economy.
Bloomberg's Oliver Crook says the final technical details will be ironed out after the summit. Russia says it will put on trial a Wall Street Journal reporter it detained months ago. Russian prosecutors accuse Evan Gershkovich of working for the CIA. They say Gershkovich collected information about a Russian tank factory. He's been detained since he was arrested in March of last year. He denies the espionage charges. Round 1 of the U.S. Open at Pinehurst is underway. Brooks Koepka is tied for the lead at 2 under through 9. Tiger Woods, also through 9, is now at 1 over. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Treasury yields fell as a cool down in another key measure of inflation reinforced that case for the Federal Reserve to cut rates this year. So let's get right to it. We have the 2-year yield down 4 basis points, 4.70.